The S&P today is a very different animal than it's been historically.
U.S. assets are still a safe haven.
I see a lot of duration risk in the market.
A couple of hard data points are already enough to really drive us a leg lower in risk assets.
This is a global rebalancing from a very overweight position in U.S. assets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Welcome to May. April's finally over. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, and the new boss is blaming the old boss.
You probably saw some numbers today. And I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in and I was very against everything that Biden was doing in terms of the economy. We took over his mess in so many different ways. When you look at the stock market in this case, it says how bad a situation we inherited.
The economy contracting for the first time since 2022 as imports surge in the face of higher tariffs. The prospect of relief, exemptions and deals helping the equity market stage an end-of-month recovery. Entering May with strong earnings from both Meta and Microsoft, offering this market some support this morning. Both names are trading higher.
To me, this really is the story that is the next catalyst that can change the market dynamic. All of a sudden, American exceptionalism, as represented by big tech, has at least reared its head and made a slight comeback with the idea that Meta not only beat revenues, but also increased its expected capital expenditures, and Microsoft increased its estimate for its cloud computing unit. This is not a market that is dying or going away. It is continuing to expand. It is continuing to double down.
It's fair to say at one point it was in April. We were down by about 11% on the S&P 500. We ended the month last month down by 0.75%.
And if you take a look at the NASDAQ, it's actually up 1% on the month. So really, talk about a whipsaw that ended up with an outcome that, at least on the surface, looks fairly calm and fairly normal. The question is, how much has fundamentally changed in the meantime? Microsoft and Meta are not indicative of the sea change that we're seeing, because both of them went out of their way to say we are not that exposed to tariffs, to some of the concerns. They are a software and advertising company. Apple and Amazon today, after the bell, incredibly exposed to the physical goods world as well as the international market in China. That will be a very different story.
China's certainly exposed. The rhetoric is changing. State-run media saying the U.S. has reached out to China for talks. Has the U.S. reached out to China for talks?
Well, clearly they have. I mean, state-run media is now acknowledging that. We've seen the behind-the-scene maneuvering. We've seen also individuals like Jamieson Greer have contact with his counterpart in China. I think what's so interesting about this post, you have to separate the signal from the noise. The noise is a domestic outreach saying things like, clearly the more anxious party at the moment is the United States. That's for domestic consumption. There is an olive branch in this post. If the U.S. wishes to engage with China, there is no harm in it for China at this stage. This is the olive branch Beijing is saying to Washington, we are ready for talks.
It looks like we're getting closer and closer to just that. In the meantime, the damage is being done, isn't it?
That's the reason why people responded yesterday to the idea that a backward-looking GDP print that Trump called Biden data, at the same time that people were looking at core PCE and how it came in at a higher pace. What you're seeing around the world and what we're going to see maybe with jobless claims and even more what people are looking for in non-farm payrolls tomorrow is how much is the pain that we're seeing already an implication from some of the changes in tariffs, and how much can you put forward look in terms of how much more to come?
Equity futures this morning positive by 1.3%, bouncing back again, driven by some powerful earnings from big tech in America. Coming up on this program, joining us will be Barbara Doran of BDA Capital Partners with stocks on a 7-day winning streak. Gardner of Stifel as the Trump administration signals trade deals are close. And Stefan Slowinski of Binky Parribas on strong results from both Meta and Microsoft. We begin this hour with stocks rising following better than expected tech earnings. Barbara Doran of BDA Capital Partners writing Q1 earnings are coming in solid as expected. It remains to be seen how much revenues, margins and earnings will be hit in the future. Barbara joins us now for more. Barbara, welcome to the programme. It's difficult to get a clean read on earnings so far. One company tells one story, another company tells a different one. How are you getting a clean read on things?
I think it's very difficult right now because most companies are either not giving guidance or they're saying, well, we'll take I think you had Merck say we'll have a $200 million hit related to tariffs. So you still haven't seen earnings come down because people still don't know. The companies themselves don't know. And you see this reflected in all the so-called soft data, whether it's the consumer surveys, business. There's clearly hesitation and a pause until we get clarity. And every day right now, the administration is talking about perhaps a deal with India. That's 3% of our imports. With Japan, that's almost 5%. So these things are dribbling out, with the biggest one being China. That's one of our top 3 importers. So we still don't know. And the effects, right now, on that GDP, the final pull-through demand was about 3%, which is good. But that was, as we have come to understand, is really because of all the forward buying ahead of the tariffs. So it's interesting when Trump blames this on Biden, it's really a response to the tariffs, I think. So I think we have to wait and see. We haven't yet seen the impacts, of this. And it'll be interesting tomorrow, the non-farm payroll, because what happens there, because yesterday, the ADP jobs number, which is private businesses, was half of what was expected. And it's not sometimes as correlated with that Friday number, but it could be the beginning of signs of softening.
This is the ultimate challenge right now, I think, Barbara, and I'm pleased you picked up on this theme, drawing a distinction between front-loading and genuine underlying demand that's sustainable through this year. And I think the same applies to both the data and to earnings too. How do you draw that distinction?
Well, I think that's a problem, because I think the earnings will come down as we start to get the data. The Fed itself has said, hey, we don't have enough information yet. We can't just go on, sentiment surveys, because we'll see how it translates into action. So, and they don't yet know if it's really going to be inflation. It's a one-time hit, and you won't know that until time passes and this starts to filter through. We're already getting reports of the empty container ships, the reduction in freight by, 1/3, out in the LA port, one of the biggest and important ones in this country. And so that has yet to filter through. And even there, we're not going to know for a few months because of all the forward ordering and buildup of inventory by retail, which it's hard to measure where all that is right now. But I think you'll start to see it in the next month or two. And then you'll be able to start to draw some conclusions and start to figure in real data. And I think you're going to see earnings come down after this report. Right now, it's a little bit of animal spirits. We've recovered half of our drawdown when the S&P was at one moment in April down 20% year to date. And so there was a lot of opportunities, but I think right now that recovery will have a strong day because of Microsoft and Meta, which were just great, really proved the AI theme, that it is alive and well. And in fact, with Meta, what happens when you do invest, you really improve your products and have more pricing control. So those will be supports, and that will certainly help in the next few days in a whole basket of stocks that are related to AI. But after that, the rest of the economy, you're going to start to see it filter through. So for me, it's a trading range, and you just have to be patient and wait for the moments when favorite names, high quality, long-term growth profile kinds of stocks, show you opportunities in terms of their valuation.
There's a lot to unpack there, Barbara. I want to just emphasize one point. You were talking about big tech starting to lead again. Is this going to be the contours of any kind of upswing in that trading range will be led once again by big tech?
Well, for a long time, people don't want it to be big tech because it's such a high percentage. But the fact is the technological innovation and change that's going on is very real and very long lasting. And so I think it's likely after this last 3 months, where they were really down in the dumps and you saw, some of these names like Meta, 30% off their highs. So, yeah, I think there's they should lead. These have sustainable earnings paths forward. And that's the kind of names that do lead in any kind of market.
So, Barbara, going forward, I'm just wondering how much the nature of the conversation is going to shift away from, say, some of the tariff volatility and going towards some of the taxes and questions around spending and how the offsets could be, and how much this could potentially roil the bond market. What's your sense of how much the volatility in the bond market has at least quieted for now, but maybe going forward, not so much?
Yeah, I think that's an excellent question, because that Because right now you're starting to hear the Republicans are trying to change the conversation to, hey, we're doing these tax cuts. There's going to be deregulation down the road. But the tax cuts we're talking about are really mostly an extension of what's already there. So it's not going to be, under Trump 1, where you really did see a big boost to the economy. It was a nice sugar high, and it did have a good effect. But right now you're talking, they've got to balance some of the tax cuts they're talking about, whether it's no taxes on tips, no taxes on Social Security, without exploding the deficit even more. And that's why you're starting to see a little bit of talk about taxing the higher earners. Probably won't happen with this administration. But I think the tax cuts really are not going to make a lot of difference. You might see an improvement on the margin, but then what you're talking about in the bond markets, the deficit will probably be even higher projected out. And that is a problem. Plus, we still haven't seen the continual effects of other countries moving away a little bit on the margin from investing in the U.S., whether it's direct investment or central banks saying, well, could keep buying a little more gold. We are still the reserve currency. We are still, the American exceptionalism is there, but it's being tamped down, hopefully temporarily by, this tariff war.
Well, Barbara, when it comes to taxes, yesterday the president said something we haven't heard really from him in months, which is that if you produce or make your products in America, we're going to have a 15% corporate tax rate. Do you think that's really part of this negotiation? If so, how bullish is that for American companies?
Well, that would be bullish because obviously that improves the bottom line, attracts investment, but it's going to be hard to see how they balance that, particularly as we're heading into a probable slowdown. Just about every economist consensus out there is that the tariffs will produce a slowdown effect and also raise inflation. Whether it's one time or not, we don't know. So it's hard to see them getting to the 15% because of the impact on the revenue collection.
Barbara,
But
appreciate your time.
It would be a positive.
Got to leave it there. It's got to catch up. Barbara Doran there of BD8 Capital Partners. Really strong earnings from both Microsoft and Meta overnight, supporting this equity market. Lisa, later on this evening, we'll hear from Apple and Amazon.
And there might be a slightly different tone. We heard from both Microsoft, Satya Nadella coming out and saying that they're somewhat more immune to some of the volatility in tariffs. You heard the same thing from Meta. Can't hear the same thing from Apple. There's some big questions about moving production in Amazon. Also, the de minimis, not to mention what they plan to do about how they signal price increases on some of their products.
I want to see how much front loading we saw over at Apple towards the end of the quarter.
Interesting.
As well, and how much they saw at the start of this quarter too. Equity futures on the S&P positive by 1.3%. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hakos. Hey, Yahara.
Hi, John. Recapping those tech earnings, we start with Meta rallying this morning, up 6.2% after it reported first quarter revenue that beat and provided second quarter guidance in line with expectations. Meta also raising its CapEx and said it's responding to the trade war by rethinking suppliers and projecting higher costs for AI infrastructure. Microsoft shares also higher, up 8% in the pre-market after it reported stronger than expected quarterly sales and profit growth. Customer demand for cloud services held steady despite economic uncertainty, with the company's Azure cloud unit posting a 33% revenue gain in the quarter, with 16 percentage points attributed to AI. And Tesla's chair denied a report that the board looked into replacing CEO Elon Musk. Robin Denholm said directors were highly confident in his ability to continue executing on their growth plan. This after the Wall Street Journal reported board members contacted executive search firms to seek a successor for Musk earlier this year. That's your Bloomberg brief. John?
Yahara, thank you. Dan Ives of Wedbush joining us later this morning on that story. Look out for that. Up next on the programme, the president building a tariff wall.
There's going to be a tariff wall put up, and they won't be happy about it. It's going to get tougher, and then it's going to be real hard to do business in this country.
We need to talk about the they. We'll do that in just a moment. Brian Gardner of Stifel joins us next, live from New York City this morning. Good morning. 7-day winning streak on the S&P 500 over that period, up 8% in yesterday's session, wiping out a 2% slide for the first time since 2022 and finishing positive. We had some weight to the rally, up another 1.3% on the S&P to kick off the month of May. To close out April, the S&P down by 0.75%, the Nasdaq up by 1.52% on the month. Just absolutely unreal. And there's surveillance this morning, the president building a tariff wall.
We're going to be getting tremendous amounts of drug and pharmaceutical companies going to be pouring into the country. There's going to be a tariff wall put up, and they won't be happy about it, but they'll be happy if they start building right now. Right now, it's going to be build, and after a certain period of time, it's going to get tougher, and then it's going to be real hard to do business in this country.
So here's the latest this morning. President Trump doubling down on his tariff plan as the trade representative Jamieson Greer says the administration is close to striking trade deals. Joining us now is Bloomberg's Mike Shepard. Mike, messaging matters. And when you start saying things like you can't have 30 dolls this year, you can only have 2, I wonder just where the messaging is in the White House at the moment.
Well, the signaling right now is becoming more apparent from the president. He is acknowledging that there is going to be some political pain in addition to the economic pain that he had already advertised previously. And since really taking office, he has talked about how his tariff program in the short term would have some turbulence for the economy, for consumers, for Wall Street. But now he's acknowledging that, look, during his News Nation interview last night, he talked about how he could even lose the U.S. House. And for him, he sees it as worth taking the hit. He is talking about building this tariff wall, and he is trying to encourage companies and consumers to get on the right side of it while they can, while these deals are still being negotiated. And he's indicating, along with Jamieson Greer, the U.S. Trade Representative, that a lot of those deals are in the works now, that they have made substantial progress, in fact, with Japan, with South Korea, and even with India. Now, the timeline on those and when they'll be announced, that's a little murkier. Some were indicating, Jamieson Greer was saying, hey, we could be doing something very soon. Scott Bessent talking about South Korea and how quickly and how much progress they have made in their talks. And yet Trump last night also was indicating, well, maybe not so fast. We want to make sure that we get the right deal, that they treat us fairly. And he even used his famous 2 weeks, John, to talk about how he viewed the timeline.
What's the status right now, Mike, when it comes to negotiations or contacts between Washington and Beijing?
Well, you know, Anne-Marie, this is the biggest question of them all, because with the world's second largest economy, we also see for the Trump administration their biggest adversary in this trade war. And China, compared to those other nations I just mentioned, is much further behind when it comes to engagement on trade. There really hasn't been much contact at all between the two sides. And there was even a kerfuffle during the IMF and World Bank meetings last week when there seemed to be some indication from Trump himself that the two sides had some sort of engagement, something that Beijing denied. And now we're hearing from China through state media that the U.S. may be making some entreaties to start talks. And that would contradict a little bit of the messaging here. We've been hearing from Trump and Treasury Secretary Scott Bessent that it's up to Beijing to pick up the phone. It's up to China to actually take the first step. But as you noted, Anne-Marie, this does seem like a little bit of an olive branch through state media from China that we're open to talking. We want to hear from you. We're ready to engage. Now, the question is with whom? And for China, they have to wonder who will be doing the talking and whose voice will have the upper hand inside the administration.
It's a rolling 2 weeks, as you know, Shep. It's a rolling 2 weeks. Mike Shepard of Bloomberg down in Washington, D.C. It's always 2 weeks away, right?
I mean, China's saying that if it's talks, the door's wide open. It's a fight. They're going to fight to the end. So there is a bit of an olive branch if they want to have a discussion.
Brian Gardner of Stifel with us around the table. Brian, good morning to you.
Good morning.
A little bit later this morning, we'll catch up with Binky Chadha at Deutsche Bank, and this is his call. 61.50 on the S&P. He says that's going to be driven by a credible relent on tariffs, and that will be shaped by damaged polls. Is this president driven by polling?
No, I think he's driven by legacy. I mean, I think that's what drives everything with the White House right now. This is the second term. There will be no third term, despite the jokes about it. But Trump has been talking about tariffs and a restructured U.S. economy since the 1980s. This is it for him. This is a one chance to get this done. So the idea that there's going to be this massive pullback despite the pause and everything, I think Trump believes this in his heart. Maybe there is some economic data, some market data that comes in later and causes them to recalibrate. You know, certainly everybody's thought there was a Trump put. I think we mispriced the Trump put to a large extent. Maybe it's still there, but I think at the end of the day, they're thinking about legacy.
Well, he basically said recently to The Atlantic that there's really no red line, no certain number that would pull him back and reverse policy. To your point, though, that he wants to see a global realignment, he talked about yesterday in this town hall the fact that tariffs are difficult to explain because he takes a maximalist approach to then bring it down. Do you believe he wants a full global realignment with some of the figures he has now, or he wants negotiated deals and terms?
I think he wants negotiated deals to get to that endpoint. That endpoint being that restructured global economy, whatever that looks like. And I don't know that he necessarily has a clear picture in his mind what it's supposed to look like, what he wants it to look like. I think at the heart, the current system, in his view, does not serve America well. And you can debate whether that's true or not. But in his mind, it doesn't serve America well. And so he wants to leave something that's better. And I think it's probably through a negotiated deal. How we get there is another matter.
So when it comes to China, what do you think this could look like? I was talking to people yesterday in Washington, D.C., who are convinced that Trump wants a grand bargain, includes things like TikTok and other levers they can pull. What do you think that deal could potentially look like?
Yeah, I think I'm not sure what the deal looks like because I think it's a lot more complicated than people think it is. So, look, China takes a much longer view than we do. They think they can outlast us, that the pain threshold that kind of Jonathan was just alluding to, that it'll be so great in the United States that the U.S. is going to have to capitulate at some point. So they're going to wait on this. The other is, you know, there's been this view in the United States that China has more to lose from this than we do. And if you look at the raw numbers, yes, that's true. You know, they export more here than goes the other way. At the same time, the U.S. exports to Chinese exports to the United States are less than 3% than the overall Chinese GDP. That's a big number, but it's a manageable number. And if you take that longer view, you can start to restructure your economy and find other trading partners to at least partially fill the void. So I think I think China is going to take much longer than people expect it to.
I want to build on John's line of questioning, where he said, right now, it doesn't seem like the polls is really a check on the president, despite what a lot of people had expected. It doesn't seem like the stock market is the check on this president's policies. What is a check, potentially, on what he decides to do, and not just what he decides to do, but how he does it?
Well, I agree, the stock market is not a check. I do think what we've seen is that the bond markets and the broader financial markets are a check. And I think you have the Secretary of the Treasury talking to the president and warning him about economic repercussions if he keeps going down in certain lines on trade policy. I think that's why we got the pause. So there are some checks. Again, we probably have mispriced all of this, right? The checks are still there. They're at just much different levels. What that level is, we don't know until we know. It's impossible to say. But like, his poll numbers have deteriorated over the last couple of weeks. The honeymoon seems to be over. Very interestingly enough, this is lining up pretty much with the same timing that President Biden saw his honeymoon end when we had the problems with Afghanistan and a few other issues in April of 2021. Maybe there is some level at which, you know, further poll deterioration causes the White House to rethink this. And, you know, because the president's not running again, he's a little bit immune to polls. But at some point, does the vice president step in? Because obviously the vice president is going to want to succeed. And how much sway does J.D. Vance have with the president? Because clearly he is looking towards 2028. Donald Trump's not.
He's got to. That's a huge question. Brian, it's good to see you, sir.
Thank you for having me.
Gardner there of Stifel. That weekend, halfway through April, the Air Force One indicator, as Annmarie called it earlier on in the last month, the person standing behind the president that weekend was not Howard Lutnick, the Commerce Secretary. It was the Secretary of the Treasury. It was Scott Bessent, and the jitters around the bond market did seem to reshape the approach to this story.
The yippee behavior in the bond market seems to be the ultimate test, which actually might be an interesting thing to look at, given that the discussion is shifting to tax cuts? And can they really do some of the tax cuts, the no tax on tips, the bigger SALT tax deduction? Can they do that without causing some sort of reaction in the bond market?
That weekend was critical for me because the way down, Howard Lutnick was standing by the president, and then I peeked my head out, and the way back to Washington, D.C., it was Treasury Secretary Scott Bessent. And what have you seen? Since Scott Bessent has been talking about trade, markets have been going up. When Howard Lutnick and Peter Navarro go out, markets go down.
The Treasury Secretary's been front and centre. Bond yields are lower by a couple of basis points this morning. Up next, the equity market is higher, and it's driven by two names, Meta and Microsoft. The latest on the earnings with Stefan Slowinski of BNP Paribas Exane. From New York, this is Bloomberg. Equities firmer this morning, higher by more than 1% on the S&P 500. A kick-off a brand new month of May. On the S&P 500, we're powered by earnings from Meta, from Microsoft, later from Apple and Amazon. With the latest, your morning movers this morning. Here's Danny Berger. Hey, Danny.
John, I want to show you exactly what the move is in these tech giants because it is sizable this morning. Microsoft, the best performer on the S&P 500 pre-market, up 8.8%, defying the gloom. It really was their Azure business, their cloud business, doing so well on AI demand. Satya Nadella also putting to rest that those stories about them pulling back on data centers, that has anything to do with them pulling back on spending. In fact, he pointed out that they signed 10 new data center leases over the past quarter. Meta, also another really strong set of results. Beat on this quarter, it beat on its forecast. Again, any of the economic concerns, the tariff concerns not hitting them. Zuckerberg saying we are well positioned to handle that macro uncertainty. Those shares up 6.4% and a huge raise in CapEx. $72 billion is what they'll spend this year. Qualcomm, though, has signed that not all tech is created equal. The big chip maker for smartphones, shares down 5.7%, a really tepid forecast. That's what it came down to. Look, they're really caught up in the crosshairs of the trade war, considering China is their biggest market for chips, saying in the earnings call that so far their earnings haven't been impacted by tariffs, but their ability to predict the future, they just can't do it, John.
Danny, thank you. Got some big news right here, some breaking news. General Motors, potentially a $5 billion hit to earnings only 2 days ago, suspending guidance. Here's the update from them. The new outlook for earnings, the guide, $10 to $12.5 billion range for the year. That at the start of the year was as much as $15.7 billion US dollars. It's an update and it's a major tariff hit.
It is an update even after some of the relief that President Trump provided in terms of having a delay to the start of some of these 25% tariffs, which highlights that they still expect a pretty big hit. They say that we look forward to maintaining our strong dialogue with the administration on trade and other policies as they continue to evolve. So there still is an opening for some sort of negotiation. Interesting to see the shares not necessarily taking a huge additional hit, which raises the question, how much is some visibility, even if it's not great, better than no visibility at all?
Mary Barra this morning saying we'll continue to be nimble and disciplined and keep you updated as we know more, and they don't know enough.
They don't know enough, and to Lisa's point, this comes after even there was some reprieve. At the same time, automakers still face that original 25% duty on imported vehicles. Hurts GM because they have plants in Canada, in Mexico, in South Korea. That is why these auto executives are not just calling the White House daily, full court press on the White House in terms of any sort of tea leaves and what's going to happen, but they are keen to know what the deals look like. Is USMCA going to be brought up forward in terms of negotiations? Will there be a deal with South Korea? Will there be a deal with Japan? The same information we have, the auto executives have, and that is why it's been hard to have guidance, and that's why they're cutting.
It's been a big cut to the outlook from GM 2 days ago, suspending guidance. An update this morning, a new range, $10 billion to $12.5 billion. At the start of the year, that number was higher by about $5 billion US dollars. For the latest on General Motors, Bloomberg Craig Trudell joins us now from London. Craig, welcome to the programme, sir. Let's just frame the moment for this company, what things look like at the start of the year, how they've changed and how they've changed in just a few days.
Yeah, I think coming into the year, GM was really doing well on the sort of old school business of selling big pickups and SUVs. It was getting things figured out in terms of its electric vehicle operations. They really struggled to kind of hit their numbers in the early goings and had issues with scaling up battery production. They had started to work out the kinks there, and things were looking good coming into this year. I think the dramatic moves that this administration is making, I think, is taking everyone off, catching everyone off guard in Detroit, because I think there was, of course, some expectation that tariffs were coming. I think it's a shock that these are applying to Canada and Mexico, and also that the administration, we've talked a lot about relief, but for this industry, we're talking about relief from really dramatic measures, and the sort of walk back is only, quite incremental. And so this really just sort of draws a line under what, Ford was saying just yesterday, which is, thank you, Mr. Trump, we appreciate this reprieve, but more work needs to be done.
These are financial changes. This is putting numbers, a price on the story. What are they doing at the operational level, Craig? What have they changed in the last few weeks, the last few months?
They've made some incremental changes and some incremental investments in terms of, adding a shift here or deciding to hire workers at particular plants. I would suspect that there's more to come there, that we will see manufacturers sort of bend to what the White House is pressing these companies for, which is more investment, fill the plants that you have here in the U.S. It's not acceptable anymore to underutilize your capacity. But that's all going to cost money, right? It costs money and it costs time. And I think if you're Mary Barra, you have to sort of get your arms around what's it going to take. She could announce tomorrow that they're going to make, a change at this plant, that plant, and the other. But if that's not going to be sufficient for this administration, then she's kind of back at square one, and investors aren't going to be particularly happy about the sort of scattershot planning on the part of the company.
Well, Craig, is it on the table right now for GM to potentially move the manufacturing of some popular models to the United States?
I guess just surface level, sure, they could try to do that. In terms of, the specifics, it's just not that easy, right? One can't snap their fingers and line up, the thousands of workers it would take to, add a shift, let alone, say stand up an entirely new factory. Ford announced a few years ago that they were going to make electric pickups down in the South and in the Memphis area. And it was a few years later, they're still standing up that production and lining up the workers for it, arranging for a supply chain that is needed to support that assembly plant. This is an industry that, even a company like Tesla that moves fast, it takes time to stand up manufacturing capacity. And, I think, speaking of Tesla, Musk on the conference call just last week was talking about, not being able to get manufacturing equipment from China as a result of tariffs. And so, even if you're a company that wants to make these investments, can you do that if the equipment that you need to put into, say, a new facility no longer can be procured affordably?
Greg, appreciate the update, sir. Craig Chadha on the latest with General Motors. If you are just joining us, welcome to the programme. It's a change for GM. 2 days ago, suspending guidance. An update this morning, a new range, 10 to 12.5 billion. The number we had at the start of the year was higher than that by about $5 billion US dollars. Lisa, how do you change your CapEx plans when the rules of the games could change? A week from now, a month from now, a year from now, 2 years from now. They're saying this morning the capital spending plans for the year basically unchanged, still seeing them at around 10 billion to 11 billion.
Policy needs to have a long-standing kind of trajectory for some of these companies to be able to really invest with any conviction. And there is a sense that possibly things could change again, so they are reluctant to really make massive investments one way or another. They are also reluctant to lose market share. We saw this from Ford, waiting to see whether they were going to raise prices, to see whether competitors did the same. You can get a sense of that macro paralysis, as you keep raising, which is correct, which is the line coming from Jim Zelter over to Apollo.
Jim's line, not mine. I won't take credit for that. GM this morning, negative, as Lisa pointed out, just a bit softer in the pre-market by 0.4%. The power for this market this morning is coming from these two names, Meta and Microsoft, surging in early trading after the tech giants beat top-line estimates. Stefan Slowinski of BNP Paribas writing the following: we see Microsoft as the hyperscaler that is sprinting the fastest towards delivering Gen AI ROI, and investors will likely continue to cheer Meta as long as it delivers revenue beats, but risks are greater. Stefan joins us now for more. Stefan, welcome to the programme, sir. Let's talk about those risks with Meta. Why are they greater with that company?
Yeah, both companies clearly delivering here, Jonathan. In Q1, really impressive, 15% growth for Microsoft, beating the high end of their guide, 20% advertising revenue growth for Meta. But looking forward, as you point out, obviously Microsoft has much greater diversification. So you've got the enterprise cloud business, you've got the SaaS businesses, you've got the OpenAI relationship. So lots of different ways to monetize AI. That's the same for Amazon, it's the same for Google, because they've successfully diversified those businesses into enterprises and into subscriptions. Meta is absolutely executing very well, but it is still 98% advertising. So that's what they're going to live and die by as they go forward here. And as they see CapEx grow by 80% year over year, as they push more into AI and Gen AI.
Did we learn, Stefan, that software providers are in a uniquely beneficial moment right now because they are somewhat less exposed to the tariff turmoil that other companies like Apple, like Amazon, maybe are more susceptible to?
Yeah, absolutely. And that's why we've been preferring enterprise software where you really don't have any direct tariff risk. Also, they have a lot of exposure outside the US where demand trends remain quite favorable. We've preferred enterprise software to internet, where advertising is at risk from more of a macro slowdown. We haven't seen that yet in Google and Meta. And clearly, even in tough times, advertisers gravitate towards those platforms. So they do benefit to a certain extent. But if macro does weaken, you will see that more. And then, as you point out, as we go down that spectrum into e-commerce, Amazon's going to be more kind of in the eye of the tariff storm, and then into hardware. You mentioned Apple tonight and other hardware names. So certainly the software side of things seem to be the most safe in this environment.
What does it say, though, Stefan, about the fact that Meta increased its capital expenditure plan and that you saw, even with a small decline in the expenditures in the third quarter for Microsoft, this commitment, this sense that demand was still outstripping supply when it comes to artificial intelligence and cloud computing? What does that tell you about the longevity of this AI trade and maybe whether it has been overestimated or, over the past couple of weeks and months, underestimated?
Yeah, AI is alive and well, and Gen AI is happening. So, that's something we keep seeing. Just yesterday, I was at Amazon Web Services Summit in London, talking to partners, talking to customers. We're moving from proof of concept into production. So AI is happening. We've had the question this year from investors, how much of the pullback in some of these big tech stocks is kind of macro related and multiple compression? How much is disappointment in AI? Clearly, we think it's the former. And we've seen multiples compress. So Microsoft, for example, started the year at 34 times forward earnings, quite pricey, but it's now pulled back around 27, 28 times, more in line with its average. Same thing for Meta. We've seen a pullback there, more in line with their averages. So I think now that we're getting confirmation that AI demand is alive and well, now that we see valuations having pulled back, and finally we're starting to get some earnings upgrades, let's see if they last. But that's the magic combination that's driving those two stocks higher today.
When it comes to policy, Mark Zuckerberg yesterday on the conference call said we're well positioned to navigate the macroeconomic uncertainty, a.k.a. all the policy changes we're seeing in Washington, D.C. Who is most immune to those policy changes?
Yeah, I think when it comes to policy and geopolitics, it's kind of a revolving door where each of these big tech companies, kind of gets its time in the sun in terms of attention from regulators. Microsoft seems pretty immune to me. They just announced yesterday a major investment in Europe and trying to appease European governments and regulators around sovereign cloud. I think Meta is maybe a bit more risk. They, if there is one ointment in last night's results, they did call out that in Q3 they could start to see a negative headwind to their operating results as they have to change their services to appease to the European Digital Markets Act. So we're going beyond just fines, and potentially they're going to have to change actually how they deliver their services, which could impact their numbers. They did flag it's only 16% of revenues that they get from EU-based advertisers, but they seem to be obviously more at risk on the European side and obviously with the FTC trial in the US.
It's a space to watch for sure. Stefan, appreciate your time, sir. Stefan Slowinski there of BNP Paribas Exane. Those two names up nicely in the pre-market. The equity market up nicely as well. Positive here by 1.2% on the S&P. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Hacker. Say Yahara.
Hi, John. We start with General Motors. It lowered its full-year profit outlook, citing exposure to as much as $5 billion in auto tariffs. GM's lowered guidance comes even after Trump issued what he's characterized as relief for automakers by lowering some levies on imported vehicles and parts. Meanwhile, Citigroup has hired former Trump trade czar Robert Lighthizer to advise the bank and its clients on how to navigate the president's trade policies. The Wall Street Journal reporting Lighthizer started working for Citi earlier this year and has already traveled to several countries to meet with clients. And a federal judge ruled Apple violated a court order by not opening its App Store to third-party payment options. The judge referred the case to federal prosecutors to investigate if Apple committed criminal contempt of court for ignoring her 2021 ruling. It must now make changes that could sizably dent its App Store revenue. Apple reports after the bell. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, the new boss, blaming the old boss.
Probably saw some numbers today, and I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in, and I was very against everything that Biden was doing in terms of the economy.
That conversation up next. Jonathan Pingle of Natixis joins us from New York City. You're watching Bloomberg TV. Good earnings from Meta, from Microsoft, powering this equity market this morning. Good morning to you all. Equity futures up by 1% on the S&P, up by almost 1.7 on the Nasdaq 100. General Motors in focus this morning. GM in the pre-market doing okay. The numbers look like this. We're up by 2.5%. The outlook, 10 billion to 12.5 billion. That's the new range for earnings for this year. It's a cut. At the start of the year, the number was $5 billion higher. Only 2 days ago, suspended guidance. We got the update just moments ago.
And they're saying that this is all because of the tariff plan. There's a 25% tariff right now for the import of auto vehicles. At the same time, Mary Barra, in her letter, the second sentence, we are grateful to President Trump for support of the U.S. automotive industry. Well, is he supportive of it, or is it the reason why you have to lower your guidance?
Okay, this is basically the classic McKinseyism. Listen, yes, all good. This is great. We're just going to cut our guidance by $5 billion and see. We're going to ongoing negotiations. Of course she's going to say this. How else is she going to message this? What I find interesting is the market's reaction. That even worse guidance is better than no guidance right now at a time when everyone has no visibility.
Are you saying they needed 48 hours to get the consultants in to come up with a way to write the letter?
I think that they needed 48 hours to see what the actual policy was, what he put out there, and then essentially the response of saying, like, look, this is terrible for us, but we're so grateful. Thank you.
Maybe they took a note from what happened to Amazon and thought, I'm going to actually use a little bit better language, put it out there in the open, and maybe we'll actually get some deals across the finish line.
These companies believe this is just the start. The rules will change again. And they could change a week from now, a month from now.
Well, honestly, this is something that we keep talking about with people who do infrastructure spending or any kind of CapEx. You need policy to be consistent for a longer period of time. It almost matters less what exactly the details of that policy are. But if you don't have a sense of what it's going to be in 2-3 years, why are you going to commit billions of dollars to building a plant?
You can't make plans. Right now, the stock is higher by 2.3% in the pre-market. Under surveillance this morning, the new boss blaming the old boss.
You probably saw some numbers today. And I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in, and I was very against everything that Biden was doing in terms of the economy. We took over his mess in so many different ways. When you look at the stock market in this case, it says how bad a situation we inherited.
So here's the latest this morning. President Trump dismissing a weak GDP print as investors await April payrolls tomorrow morning. Jonathan Pingle of Natixis writing, we estimate that non-farm payrolls rose by 140K. We are unlikely to see the brunt of the effects from the administration's recent policy actions in April's employment report. Jonathan joins us now for more. Jonathan, good morning.
Morning, Jonathan.
Give us the clinic then. Why is it too early to see this?
I mean, every indicator of consumer demand that we've seen so far in April has been decently strong. Retail sales kind of was easily maintained, layoffs remained low, job openings were still somewhat elevated compared to what we've been seeing, even though they're cooling. It does not look like this is where the tide kind of broke.
How useful is ADP?
As a predictor
As a read-through into
payrolls,
NFP?
no, it's not
Useless.
useful. Yeah. It is, I think, an interesting and useful indicator of the labor market as a whole. The Fed at various points has put a weighted indicator of ADP and non-farm payrolls to look at it together. But no, it's a poor predictor of payrolls.
During the year of April, we had a lot of different kinds of mood swings and senses of what was going to happen in terms of growth, in terms of inflation, in terms of deals, in terms of tariffs. And there is this question of how you come up with a forecast in all of that. So as someone who has been an accurate forecaster in the past, how are you doing it?
I mean, it's challenging. I was in Europe for investor meetings a couple weeks ago. And it was on April 9th that I flew out, and we printed out the slide deck that morning, and by the afternoon, I had to redo the whole thing. No, you go back to the basics, you look at the path of the monthly data going forward, you look and see where you see the pass-throughs and how that comes, and you end up making a path from there. It's really interesting looking at something like payrolls right now. You commented, I think, on Twitter the other day that it's weird talking about the weather. It's kind of really nearsighted doing this type of conversation. And when you're doing a forecast for April payrolls, it's like, ooh, March was really, really warm. It's not going to be as much this month. And it does feel nearsighted. It doesn't feel like this is the outlook for the economy. And we actually don't even think it'll likely slow down that much until mid-late March or mid-late May, in which case the first data you're really going to see that might be pretty negative or poor is kind of June.
You've been traveling around the world talking with clients. It comes at a time where it seems like the market has shifted away from thinking that the rest of the world would suffer more greatly than the United States when it comes to tariffs. And now the pain might be uniquely focused in the United States and the rest of the world is doing better. What you saw, did it confirm that kind of feeling that you're seeing in markets? Is it reality?
I mean, the sentiment abroad is certainly much more negative than it is domestically. I think there's this somewhat decent consensus in the United States that we're at peak tariff, that this is going to be walked back, that somehow this resolves itself a little bit better in a few months. That is not the case when you're looking at it abroad. And I think you see that especially in inflation expectations, right? Inflation expectations domestically are that it'll eventually kind of come back. The five-year looks pretty decent. Like 5 years, even just inflation swap look decent. There is not the pricing in Fed funds. There's not this idea of we're going through an inflation shock and the Fed's going to have to respond to that. The idea abroad is the opposite, right? Like that these tariffs are here to stay. We have to learn how to manage it, and we have to learn how to adjust to a very uncertain U.S. policy.
Isn't that interesting that they think they're here to stay, given the fact that the administration is very consistent, at least with everyone barring China, that they're going to get deals? How much clarity do you need on China, that one specifically, that 145%, in order to have really positive or accurate forecasting?
It's hard. I mean, I think one of the things you go back to really basic indicators, how many different containers are arriving to LA ports. You go back to these COVID indicators of supply chains, right? And Torsten Slok's done a lot of good research on this. I think one of the more interesting parts is that you're actually looking to see a pickup in scheduled orders there late May, in which case, at some point, firms were like, all right, there's so much uncertainty, we're not going to submit new orders. And then you're like, let's just try passing these costs through. Let's submit the order, and let's see what happens. And that's when you should start seeing some changes in prices and eventually these tariffs biting.
That's the process I'm interested in. When you frame this for clients, do you talk about it as a one-off event, a shock, or do you describe it as a process that's beginning over the next few months?
I mean, the overall bulk of U.S. policy changes that has happened over the past few months is increasingly negative for U.S. growth, both in the short and long term. I think investors are concerned both about the short term, what you're doing, and how this looks for the U.S. for the next 5 years. And there is a lack of confidence in the administration and the ability for that to be rectified.
Jonathan, it's good to see you.
Good to see you as well.
Fantastic as always. Jonathan Pingle there over Natixis. The latest on the economy and the economic data. Here's the latest on the earnings and the guidance. Harley-Davidson, the latest company here, Lisa, withdrawing their outlook for 2025 because of, guess what, the tariff situation and macro conditions.
Well, and let's just be clear, Harley-Davidson has been uniquely targeted by the likes of Europe as one area to go after because of its southern base, and or Midwestern base, actually, but also its presence in red states. I just wonder how much we're going to see this and how much it's going to get punished in markets.
Seeing a lot of it. That's the latest in corporate America. Up next on the programme, we'll catch up with Binky Chadha of Deutsche Bank, the former Deputy National Security Advisor to President Biden, Daleep Singh, Lauren Hochfelder of Morgan Stanley Real Estate Investing, and Thierry Wizman of Macquarie from New York, the second hour of Bloomberg Surveillance. Up next.
A lot of companies are quite uncertain about where things are going.
We gave too much credit to the resilience of the economy.
Undoubtedly, we're going through a period now where it's not just the soft data, it's the hard data.
The direction to travel certainly is in the direction of stagflation.
The reality is this is a stagflationary shock.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P adding some weight to the rally. A 7-day winning streak on the S&P 500, again, over that period of 8 percentage points. Futures up across the board, up by 1.7% on the NASDAQ 100, helped out by this. Really decent earnings from both Meta and Microsoft. The two of these names higher in the pre-market by more than 5%. Microsoft up by close to 9%. Check out GM. General Motors this morning offering an update to the guidance after suspending it only 2 days ago, and the outlook isn't great compared to what the outlook was at the start of the year. The outlook at the start of the year, they were looking for something close to 16 billion. Now it's something like 10 to 12, Lisa, for that company.
Yeah, saying that they're going to take potentially a $5 billion hit from the tariffs and some of what they have already seen from the president's policies. This comes 48 hours after withdrawing guidance. I want to just note that GM shares are up about 2.5% in pre-market trading, which is notable. Maybe some guidance, even if it's negative, is better than no guidance. We keep seeing this. People who have some visibility at a time of such uncertainty seem to be rewarded in markets, even if that visibility isn't great, as long as it's not coming from some fundamental weakness that they're just trying to blame it on tariffs.
Corporate America, the markets, they just want to know what the rules of engagement are. And at this moment, you have an administration that's actively talking about that they're very close to clinching these trade deals. You don't know specifically what the tariff rates are going to be. What I find just almost funny about what GM is doing. They're saying they're going to take this $5 billion hit. The second sentence in this letter is, we are grateful to President Trump for his support of the U.S. automotive industry, yet they're blaming Trump for the $5 billion hit because they don't know what the tariff picture is going to look like.
AKA would like some more help. So let's talk about where that help might come from. China. Talks potentially on the table. Help us understand where things are. State TV just yesterday putting out a social media post suggesting the United States was looking for talks.
I think this is an olive branch from Beijing. There is some hot rhetoric in it that will be interesting for the domestic audience in China. But it goes on to say, if the U.S. wishes to engage with China, there is, quote, no harm in it for China at this stage. What they are saying is, we are hearing you, we are seeing this contact, and we're willing to engage, and maybe we'll see actually talks. And the talk will be an actual phone call between Xi Jinping and Donald Trump.
Meanwhile, where is the damage being done? It's difficult to get a read on the U.S. economy right now. Later this morning at 8:30 Eastern Time, you'll get another read on the labour market, jobless claims ahead of payrolls tomorrow. Right now, you're getting another read on the U.S. economy through a very important company, McDonald's. Those numbers just drop in.
Yeah, and the sales miss comes out with comments from the executives saying that essentially this is a deeply concerning moment. Consumers today are grappling with that uncertainty and spending less. They saw the largest U.S. same-store sales decline since 2020. He said that he did believe that McDonald's has the ability to navigate, quote, even the toughest of market conditions and gain market share. That said, McDonald's is uniquely exposed to a lower-income consumer and middle-income
income consumer. What does this say about how much some of the ramifications are already being felt throughout a number of different groups in the United States?
And they were squeezed under the Biden administration, and the worry is they'll be squeezed even more with these changes to trade policy, at least in the near term. Equity futures on the S&P 500 positive here by 1.2%. Coming up this hour, Binky, Chadha at Deutsche Bank looking for stocks to kick higher from here. We'll catch up with the former Deputy National Security Advisor to President Biden, Daleep Singh, and Lauren Hochfelder of Morgan Stanley on real estate investments. We begin this hour with stocks higher. The S&P 500 posting a 7-day winning streak. Binky, Chadha at Deutsche Bank writing, our base case remains for a significant rally on a credible relent on trade policies with a target of 6150 by year end. Binky, good morning. Good to see you, sir.
Good morning, John.
6150, the new target. It's down from 7K. Let's deal with the language there. A credible relent on trade policy. What does that mean to you?
So, it's meant to capture an idea, and it's about convincing the market that you're sort of done with the trade policy issue. There is a huge amount of uncertainty about the different ways that can be done. And at the end of the day, given where we are, I expect it will be kind of mushy. I don't have a better word than that. So some trade deals, perhaps some lowering, the big question mark about the 10% uniform tariff, because by the uniform tariff that we have put on ourselves, we've hurt U.S. growth more than we are hurting anyone else.
Lisa asked the question where the pressure would come from. Where do you see the pressure coming from? What drives that credible relent?
I think at the end of the day, it's the same thing. So when you think about presidential elections, we've all heard it's about the economy, stupid, in the sense that other things matter, but it's mostly about the economy. And so I would argue it's presidential job approval ratings. And because, if you think about if the presidential election is about the economy, and then you ask people, where do we ask people, how do they feel about the economy? It's consumer confidence. So the typical pattern is new presidents start with a hefty sort of goodwill of a honeymoon period of high approval ratings. The honeymoon then tends to wear down, and the question is, where do we land? We land at levels that are basically, dictated by consumer confidence, I would argue. Happened the last two administrations. And so, we are midway in that process. We started up here, we've been coming down, and the trajectory right now. And I would just remind that current consumer confidence levels, suggest that you might get down to 30%. And so I think there will be a reaction long before.
Yeah, there's some pretty negative soft data that have been coming out. You talked with us when you had still a 7,000 rating, 7,000 target on the S&P 500, saying it was a matter of time. Mm-hmm. And if this uncertainty didn't get resolved, you would have to bring your forecast down, which is part of the reason why you did bring your forecast down. Right. Now there is a question of how much longer can this go on before you bring it down again, before you cannot put the toothpaste back in the tube, you cannot put the genie back in the bottle, pick your potential saying. How much are you looking at that?
Very much. I mean, I think that, the risk is that the relent that we were talking about comes basically too late and the nonlinearities of recession kick in. I think one has to be honest, which is that it's just very difficult to gauge what the impact of the tariffs is going to be. And by that, I mean, I think they're clearly negative for U.S. growth. They're very negative for U.S. earnings. Precisely how much is the question. I mean, on a 12-month basis, we calculate that the impact would be $56 of U.S. S&P 500 EPS. And just to put that number in perspective, last year we had $250 of earnings. So if you're talking about $56 hit, that's a very large number. It's a very large number by any standards. And so, yes, the nonlinearities of recession can kick in and the relent might come too late. But, then you have to think about basically, okay, so if we're going to go down, maybe we have a recession, getting a recovery from a supply side recession doesn't fit the typical playbook. So it's something that will have to be, seen and worked out, basically.
Do you get the sense that big tech is going to lead this charge? That is essentially what we have already seen from both Meta and Microsoft, as well as Alphabet last week, that there's sort of a resurgence in faith in U.S. tech that can bolster some of the pain that you might see elsewhere from the likes of McDonald's or GM or some of the other companies that are more hit.
Yeah, what I would say is, earnings are basically saying they're hanging in right now, and earnings are fine. But again, this is about yesterday, not about tomorrow. And the question is, what happens tomorrow? So, our take is that earnings growth for the first quarter currently, looks like it's coming in around 10% year on year. That could drop to basically zero in the second quarter that we are in, and then basically turn negative on the baseline view that the announced tariffs all come into effect and stay. It's just, if you think about the numbers, they're just, horrendous.
Binky, you talk about this relent. What's the level? What's the destination you think we're going to get to in a base case scenario?
I don't know is the honest answer. I think it's all getting worked out dynamically, and so the circumstances and what happens, so it's data dependent, to use a bad term.
So you think it's politically driven?
It's a question of, yeah, I think it's political. Yeah.
So basically they have till November 3rd of 2026.
The midterm elections start a lot earlier, and I would argue, the clear and present danger is to approval ratings. They have, sort of predictable consequences on your ability to govern. So we shall see.
Binky, we shall see. It's got to get an update from you. Thank you, sir. Appreciate it. Binky Chadha there of Deutsche Bank on the equity market. Looking ahead to more earnings a little bit later on this afternoon. You will hear from Apple and from Amazon. Equity futures at the moment positive by 1.2% on the S&P, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hecker. Say, Yahara.
Hi, John. The U.S. and Ukraine have reached a deal granting the U.S. privileged access to new investment projects to develop Ukraine's natural resources. The agreement creates a fund to attract global investment into Ukraine, with the U.S. getting first claim on profits transferred into the fund, which will be jointly managed by both nations. And General Motors lowered its full-year profit outlook just 2 days after suspending earnings guidance. The company now citing exposure to as much as $5 billion in auto tariffs. GM's lowered guidance comes even after President Trump issued what he's characterized as relief for automakers by lowering some levies on imported vehicles and parts. And Morgan Stanley is planning to add crypto trading to its E-Trade platform. The firm is looking into partnerships with established crypto companies to allow clients to trade Bitcoin, Ether, and other tokens. The move would mark the most significant action from a major U.S. bank to help everyday investors buy into the asset. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, the president downplaying the price of tariffs.
Somebody said, the shelves are going to be open. Well, maybe the children will have $2 instead of $30, And maybe the $2 will cost a couple of bucks more than they would normally.
Up next on the program, reaction from the former Deputy National Security Advisor to President Biden, Daleep Singh. Daleep joins us next from New York City this morning. Good morning. Close to session highs in the equity market on the S&P 500 up by 1.2%, on the S&P, on the Nasdaq up by 1.8%. Under surveillance this morning, the president downplaying the price of tariffs.
Somebody said, the shelves are going to be open. Well, maybe the children will have $2 instead of $30, And maybe the $2 will cost a couple of bucks more than they would normally. But we're not talking about something that we have to go out of our way. They have ships that are loaded up with stuff, much of which, not all of it, but much of which we don't need.
Here's the latest this morning. The president downplaying the price of tariffs with corporate America pushing back. GM joining the long list of companies to slash its outlook, citing higher levies. Bloomberg's Mike Shepard joins us now for more. Shepard, welcome back to the show, sir. Mike, I want to talk about this. The pressure coming from corporate America, the cut to the outlook from GM, the softer numbers we just saw from McDonald's. How sensitive, how responsive is this White House to the pushback that they might be getting from corporate America?
Well, so far, they have not been convinced or swayed by any of that sort of pushback. You heard the president just talking about this in terms of dolls, but really the warning that we got from GM about the cost of tariffs signals that it is something far more than just low-cost commodity items coming from China. For instance, the main adversary in Donald Trump's trade war. Really, it is across around the world. Supply chains globally are being affected by this. And the risk for companies is that their costs are going to increase because of the components that are coming in. We also saw Harley warning of increased risk and inability to project further because of tariff-related costs. Now, whether the administration is going to start heeding these calls is a different question. GM and other automakers have already been lobbying the administration extensively for changes to the autos tariffs and for some sort of a reprieve. And they already got one on Tuesday before the president's trip to Michigan. We saw him sign an order giving them a little bit of a break on, I guess, a reimbursement, if you will, on tariffs that are imposed on imported parts, the ones that they would need to assemble cars here. But imported cars, which GM imports from Mexico, from Canada, and from South Korea, fully assembled, those are still subject to the full 25% tariff. And that is a big hit to their bottom line, John. And it's something that the president and his team will have to start paying attention to as they enter into these negotiations with other trading partners.
Mike, when the president talks about dolls, he's talking about access to cheap consumer goods. And obviously that talks about China. He said yesterday that that's a very good chance he can strike a deal with China. But he said he wants to make it on our own terms, and it's got to be fair. How long is it going to be for this administration to bring 145% tariff level down when it comes to Beijing?
Well, it will take a long time. The two sides really have to, at first, you were talking earlier about a call between Donald Trump and Xi Jinping. Before that even happens, so you need to have lower level advisors make that first contact, have those initial discussions. And getting a trade deal done, as we have observed over the years, is not something that you do like speed dating, as we, in a way, are kind of seeing here with all these other trading partners around the world. Talks happening with India, with South Korea, with Japan, with the European Union, which is going to present its proposal to the U.S. next week. Now, all of this is unfolding at the same time, and trying to reach a complex trade accord with China, which is really smarting from all of the trade pain it is feeling right now from the U.S., is going to take some time. It's complex. China also wants to bring in issues like Taiwan and some of the tech-related export controls that the U.S. has been imposing over years. So it is going to be a delicate dance with Beijing, but also with all these other trading partners around the world, Annmarie.
Hey, Shep, appreciate your time, as always, from the nation's capital down in Washington, D.C. I'm pleased to say that here in New York City, joining us around the table, the former Deputy National Security Advisor to President Biden, Daleep Singh. Daleep, good to see you. Now the Vice Chair, Chief Global Economist and Head of Global Macroeconomic Research at PGIM. That's quite a title.
You can just call me Daleep.
Happy just to call you Daleep. Daleep, let's get to this. How are you framing the next 12 months for clients? Never mind the next few weeks of economic data. What does the next year look like for you?
You can't get past the economic war we're in with China. Look, I mean, this is the world's undisputed trading and manufacturing superpower. It has unrivaled production scale. I mean, don't forget the lesson of the 1940s. Scale is strategic leverage. Okay, we're not just talking about dolls or furniture or bicycles or underwear. We're talking about goods that are critical for our economic security, our national security. So think about steel, cement, robots, drones, chemicals, pharmaceuticals. This is going to be a blinking contest. And in my opinion, we need China's supply at least as much as they need our demand. Think about this. Which country has a political system with a higher tolerance for economic pain? China. Which country has more policy space to cushion against economic pain? That's China. And which country has an interest in unraveling the economic order that we built? China. So look, we can get the upper hand again. I think what clients have to watch for is, can we pull off a diplomatic masterclass? get Europe and Asia back on sides, get them to collectively tariff China, isolate Beijing, and pressure them to stop distorting global markets with overcapacity. That's what's at stake.
In your time in government, how difficult is it to do just that? And what were the lessons from your experience down in Washington?
It's very simple. If you're tariffing alone and you're tariffing across the board, that's a self-defeating strategy, and Beijing knows it. They know they have the cards. That's why we're making the calls to them.
Daleep, though, Beijing is feeling some of this pain, though. That Weibo post from CCTV came out the same day that we saw factory orders in China plunge. How long do you think it is until Beijing really does think, I need to come to the phones, I need to pick up this call from President Trump?
Annmarie, China plays the long game. They are not focused on quarter-over-quarter GDP numbers. They're a mercantilist power that thinks about leverage as strategic scale. If they're gaining global market share, they can endure far more pain than we can. We're sensitive to markets, we're sensitive to polls, we're sensitive to CEO sentiment, we're sensitive to back-to-school items. It's a very different reaction function here than it is in Beijing.
The Treasury Secretary, a number of the president's economic advisors, talking about getting these deals done very quickly with partners, South Korea, India, et cetera. How likely is it for those trading partners to also want to confront China alongside Washington?
My sense is they'll be eager to strike agreements in principle, memoranda of understanding, use whatever term you want, to reduce the threat against them. But when it comes to raising tariffs with the United States to isolate China, I think that's less likely because countries all over the world right now are hedging their bets. There's just too much uncertainty for them to decisively pull themselves into our strategic orbit. So, we're going to have to do this negotiation mostly by ourselves at this point.
During the Biden administration, you would say things like, we're not trying to decouple, we're de-risking from China. What are we doing now?
Well, I think under the current tariff proposal, we would be decoupling from what matters least without de-risking what matters most. So we'd be decoupling from items like bicycles and toys and underwear and low-margin commoditized goods. But I hear much less about maintaining export controls for our technological crown jewels. That's what we meant when we said de-risking. Those are going to be the items that determine our economic growth potential and our national security being intact. And I fear that the kind of deal we may end up with China is going to give away those crown jewels.
But the Trump administration has kept on the Biden administration export controls. You think they need to do more?
Well, they need to do more, and they need to keep the controls in place. And if I had to sketch out what an agreement in principle could look like with China, I was listening to your earlier guest on stage. We could very easily have an agreement in which the United States gets concessions on fentanyl, something on the Panama Canal, purchase orders on soybeans and aircraft and LNG, and some reduction of tariffs by China. China would also get a reduction of tariffs, let's say 60%, generous exemptions, some type of reprieve on TikTok. But again, the real prize for Beijing would be a relaxation of our export controls on the technological crown jewels. I fear that's where this is headed.
Negative supply shocks, as you know, can have ripples and tremors long after they finish, even if they are short-lived. We saw that in the pandemic.
Yeah.
Let's get short-term, medium-term. What does this look like from here? We've seen the freight bookings, the ship bookings all start to roll over from China to the United States. Then we're all asking similar questions. We've all been talking about it. When do we start to see the empty shelves, the price hikes, the lack of access? When does that start to appear?
I think it can take about a quarter. There's been a lot of, you saw in the Q1 GDP data, a lot of front running, a lot of inventory stocking. It'll take about a quarter for that to be exhausted, and it'll start to show up in the hard data, let's say Q2, Q3. And that's when this is going to bite. That's when the pain will be strong enough for the United States to more formally try to seek a meeting at the leader level, which is ultimately how this is going to get brokered.
There's a larger question about how this changes some of your assumptions longer term about how you understand the economy, how you understand growth, how you understand inflation. You had some pretty dire comments in some of your notes to us about the idea of American exceptionalism trade being over for at least a decade. How much does what we have just seen shift your view of the world order going forward as expressed in markets?
Yeah, look, we just got out of April, and when U.S. equities and bonds and the dollar sell off together, markets are delivering a pretty stark warning, right? So everyone in the world right now is questioning, are our foundational strengths still intact? Rule of law, due process, checks and balances, independent institutions, professional civil service. Countries are wondering whether they can still trust America as a reliable and predictable partner. There are questions as to whether we can still attract the best ideas and talent from across the world. Can our universities and our scientific research still be the lifeblood of innovation? And I think most crucially, and this will come later in the year, can we credibly put our debt and deficit trajectory on a sustainable path before it crescendos into crisis? The fact that those questions are being asked every single day is itself a problem. And if we don't put those questions to rest, the reversal of the American exceptionalism trade is going to be the least of our worries. But yeah, I mean, if you look at the U.S. market share in global bond markets, equity markets, and currency markets, it's about 40, 50, and 60% respectively. It's not far-fetched to imagine those numbers could retreat back towards our share of global GDP, which is 25%. And that doesn't mean the end of dollar primacy. It does mean we pay a heavy price in terms of our funding costs, in terms of our fiscal space, in terms of our ability to absorb a shock, or our ability to deliver a shock.
Daleep, wonderful to see you, as always. Thanks for being here, sir. Daleep Singh there of PGIM. I'm going to say this for you. You don't have to agree with this. Every administration makes mistakes. One of the biggest mistakes of the Biden administration, not letting people like Daleep engage with the media a whole lot more. From New York City, this is Bloomberg. Seven days of gains on the S&P 500, the longest stretch of wins so far in 2025, and over that period higher by 8%. This morning we had some weight to the rally, up another 1.1% on the S&P, driven by some really strong earnings from big tech. On the Nasdaq 100, up by 1.7%. With 2 hours until the cash open, let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Let's look at those movers from big tech. Microsoft is up almost 9% in the pre-market trade. Really strong results from cloud. It is that AI demand that Satya Nadella talked about on the call, saying, look, those reports of us canceling leases in the U.S. for data centers, it has nothing to do with us having weaker demand for it. In fact, they talked about laying out new data centers, 10 in the past quarter, and continued spend. Speaking of continued spend, Meta said that it's going to spend $72 billion this year in capital expenditures. That compares to 39 last year. A sign of confidence for the company, which is up 6%, beat on the quarter, beat on its forecast, saying that it doesn't have that terrorist-induced shock, that Zuckerberg feels that the company is well positioned to withstand any macro uncertainty, a big fear coming into this quarter. Finally, one of the other big gainers pre-market off the back of their earnings in the 6 a.m. hour, we heard from CVS, a beat. They're also pulling out of the Affordable Care Act marketplace. That's something that they lost money on, but really the gain of 8 1/3% has to do with the fact that they're partnering with Wegovy, Novo Nordisk rather, making Wegovy their medicine of choice when it comes to weight loss, and now giving cash discounts for Wegovy, so that in itself sending shares higher, John.
Danny, thank you. Appreciate it. That stock up by 8.4% now in the pre-market. The opening bell just a few hours away. On our radar this morning, one of our top stories, the US reportedly reaching out to China for trade talks. Chinese state media reporting the US is using multiple channels to start discussions on the levies.
Yeah, this to me is a really interesting question. Who's talking with whom? Is any of this real? How close do we get to some sort of transactional deal? The big question, and Daleep Singh was talking about this just a moment ago, about how much leverage each side has. Who can tolerate the pain for longer? That's really come to the fore as we start to get into this grade school discussion of who called who first.
Well, if it's politics, the United States has months. China has years, maybe even decades, and you could see that with even some of the social media posts they're putting out. They're going to fight to the end. What is so interesting about this post, though, from this affiliate to China State TV, is it is a clear olive branch. They are saying that the United States is more anxious at this moment, a little bit of a domestic flair there. But if the U.S. wishes to engage with China, there is no harm in it for China at this stage, basically saying we are open for business to have this discussion. The whole who's going to make the first call and where it's going to be. Will it just be a phone call? Will there be someone appointed?
Does he like me?
That's the semantics around it. The fact of the matter is they will have a conversation.
They'll end up in a room, perhaps by accident, and that number will come down. That's the consensus on Wall Street. So what? Maybe down from something like 140, 150 down to what? 50, 60, 70? That's basically the consensus view on Wall Street now.
And now the bigger question is, what is sustainable? Is 60% sustainable? Meh. Is 50% sustainable? Maybe. And what products, what types of exemptions are there going to be? Can I just say,
this is going to be just a public service announcement. I don't care who calls who. Ultimately, there's no judgment. Just go ahead, have that conversation. There's no pride lost. You both like each other. There's this feeling of like, really, are we really doing this?
Guess what? Wall Street doesn't care either.
No, not at all.
Wall Street just cares the signal is there that both sides are interested in engaging in talks.
And guess what? We'll have two different readouts, one from Beijing, one from Washington, that will say President Trump called Xi if you're in Beijing, and Xi called President Trump if you're in Washington. Everyone will be able to save face to their domestic audience, and we can get the negotiations on the road.
That conversation ongoing. Let's turn to Tesla. The chair denying a report that the board is looking to replace the CEO, Elon Musk, saying directors are confident in his ability to continue executing on the growth plan. This coming after the Wall Street Journal reported in the last 24 hours that some board members were seeking to start the process to find a successor.
Whether this is still valid remains to be seen, and we'll talk to Dan Ives about that in just a minute, whether this is still a relevant discussion to be had. The fact that it was being had, though, highlights just how much damage Elon Musk's distraction and potential affiliation with the government have been doing to Tesla, the company. If this is true, and the company is denying it, if this is true, it highlights what they were considered doing as a result of their CEO running 5 different companies and the Doge effort in Washington, D.C.
I know Elon Musk and the chair of Tesla is pushing back on this, but there's one part of the story that is absolutely true. Board members told Elon Musk he needs to spend more time at Tesla and needs to say so publicly. And he did say so publicly. On the last earnings call, he said, next month, I'm going to be stepping back from Doge, focusing more on Tesla. And we heard him talk about this yesterday in the cabinet meeting. And the president said, you always have a seat at the table, but I know you want to go focus on your cars.
Yeah, most investors not interested in how we got here, just interested in that he's back, and he seems to be back. We'll catch up with Dan Ives of Wedbush later this morning and talk to him about this name. And this name too, a federal judge ruling against Apple, saying it violated a court order requiring it to open up its app store to third-party payment options. The judge ordering the tech giant to stop charging commissions on purchases outside its marketplace. That name is down by 1.5%. Earnings from Apple front and centre after the close later.
There are antitrust issues, there are court case issues, and frankly, they face a much higher hurdle when it comes to some of the profitability and visibility, given that they are deeply exposed to China, both on the production side as well as on the sales side, and they are a physical goods side. They have to come over on that ship. It is different when it's software versus something physical and tangible. That is why I think Apple earnings are going to be particularly notable.
After the closing bell, alongside Amazon, look out for that. Let's turn back to tariffs. Levies on building materials from lumber to steel threatening to impact the real estate market. Lauren Hochfelder of Morgan Stanley Real Estate Investing remaining optimistic, writing real estate was already over 3 years into a correction prior to April 2nd, and the market is set up well for a recovery. Lauren joins us now for more. Lauren, good morning. Good to see you.
Good morning. Great to see you.
Thanks for dropping by. Some people are framing this as the great repatriation of US manufacturing back to America, the big rebuild. How would you frame things?
Well, I think it's funny. Everyone's talking about tariffs these days, and of course that is a huge deal. But let's not forget that this restructuring of the global supply chain didn't start on April 2nd. We were seeing long before that companies, having learned the hard way about putting all their eggs in one basket, they were grappling with this U-turn on globalization, grappling with these event-driven supply shocks, COVID, Panama Canal, you name it. Tariffs are one more critical proof point in that they need options. Some of those options will be here in the U.S. Some of them will be in other markets around the world like India.
What are you seeing in terms of the types of facilities that companies are investing in as a long-standing policy shift toward repatriating supply chains or redirecting them? Is it putting tubes in a toothpaste into a tube and putting the little handle on it, or is it something like data centers and other type of issues?
Yeah. Well, it's interesting, right? That you see sort of the memes of those toothpaste and T-shirts. And no, I do not think it's going to be generic manufacturing, commoditized manufacturing here in the U.S., but you do have automated manufacturing, you have, various types of advanced manufacturing and just critical goods. So it may not be toothpaste, but it can be defense in the Midwest. It may not be T-shirts, but it can be building materials in the Carolinas. So we think there's a lot that actually can be reshored back to the U.S.
How much have you seen those investments pick up after the election and after even some of the tariff announcements that we saw about a month ago?
Well, I think that you've been seeing that investment increase since really 2020. So when companies really faced that immense economic disruption driven by the supply chain breakdown. You started to see that plus, frankly, government policy incentivizing building here in the U.S. Since April 2nd, it's hard to say there have been such substantial steps just because we're in a period of uncertainty. And what do companies do in periods of uncertainty? They generally tend to pause decision making.
Which areas are getting the biggest slew of investment as a result of this? And how much have prices already gone up in anticipation of this expected investment?
Yeah, well, it's a few things. First of all, on price increases, I'd say one of the interesting things for real estate is that one of the real tailwinds as we look forward is new construction is so far off. And what will tariffs do? We know they'll make it more difficult, more expensive to build, which will push back the inevitable supply side response. So we think actually, perhaps counterintuitively, long term, this could be really good for real estate because of that cost impact you're discussing. In terms of, which markets, we think that it's those markets that are less reliant on cheap labor. Can be more benefited by technology, which should be a tailwind to domestic manufacturing, and those markets, frankly, that would benefit from the relatively lower cost of energy here in the U.S.
You mentioned government policies. We now see on Capitol Hill they're debating pulling back Inflation Reduction Act credits, things like maybe the CHIPS Act, those grants, that could be up for grabs. Will that have an impact on building and real estate in America?
Absolutely. Look, it's variables upon variables. It's sort of this Rubik's Cube of outcomes, really. But absolutely, all of these things will, because supply chains are ultimately very complex, and they depend on cost and resilience and all of these things. And policy obviously has a way of distorting the cost equations. So absolutely, but I do think you're seeing, at least in the short term, a pause, because companies rightfully are saying, what's this going to look like?
Let's finish with an area that you really like. When I moved to America about a decade ago, I thought people moved to Florida to retire because of the weather. I found out later on it was about the taxes.
I think the weather's a big part of it.
I'm sure the weather's got something to do with it too, maybe for the rest of us. How are you thinking about retirees in America and investment opportunities on the real estate side?
Yeah, look, we think this is the golden age for senior housing. When you think about what is the ultimate needs-based real estate, it is, there is a silver tsunami underway, right? We can sit around and debate tariff policy or interest rates, but what do we know? We know this population is getting older, and with that, its housing needs change.
Where are they retiring to? Because I can't afford to retire in New York City. Where are they going?
Well, it's, senior housing is really throughout the U.S. It tends to be linked less to whether it's, Florida and whatnot, or where frankly, the oldest daughter lives is actually statistically the most predictive element.
Is that true? Really?
Yes.
Amazing. I did not know that.
Yes.
I'm a little bit insulted at the moment. I'm the youngest daughter. I guess that means I'm losing my parents.
So they're going upstate, is that right?
We're going upstate.
Okay, all right. Lauren, appreciate it. Thanks for being here.
To see you.
Thank you very much for dropping by. Lauren Hochfelder there of Morgan Stanley Real Estate Investing. If you are just joining us, welcome to the programme. Equity futures up nicely this morning off the back of earnings from big tech. Earnings elsewhere really, really interesting. We're seeing cuts to guidance. We're seeing guidance pulled. Cuts to guidance from GM. Pulled guidance from Harley-Davidson, and soft earnings from McDonald's as well.
Yeah, and different stories, right? I mean, this is one of the reasons why it's so difficult to really come up with a cohesive narrative. GM saying we're going to take a $5 billion hit, we're going to lower our guidance. HOG, or Harley-Davidson, HOG is the ticker that you can see, withdrawing guidance, especially given the fact that they're getting pushback from Europe, but at the same time, maybe other places might offset that. McDonald's. How much are we going to see lower income consumers really retrench from spending first? And how much is that already some kind of breaking point that we're seeing play out in the data?
Not a great read on things from that corporation this morning. That name is down by close to 1% in the pre-market. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. Staying on McDonald's, those shares are falling nearly 1% after reporting a sales decline in the first quarter. Sales dropped 1% globally compared to a year ago, driven by a big decline in sales here in the U.S. The results suggest that McDonald's focus on affordable menu options have not been enough to get anxious consumers to spend. Meanwhile, Ford says it will not increase the price of its vehicles until it sees how its competitors respond to higher costs from tariffs. This comes after it had previously said it planned to raise prices in May. CEO Jim Farley says Ford will detail how much the levies will increase its costs when it reports first quarter earnings next Monday. And EV maker Rivian is said to have stockpiled a reserve of batteries from Asia ahead of President Trump's tariffs. Sources say it acquired a supply of cells from China late last year ahead of the U.S. election. Sources told Bloomberg that Rivian has also recently worked with Korean supplier Samsung SDI to move a large amount of battery inventory to the U.S. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the programme, the greenback safe haven status in question.
We don't think the dollar is going to lose its reserve currency status overnight. I think there could be a risk over the long run if the goal here by the Trump administration is to reduce those trade deficits. It means foreigners over time don't need to hold as many dollars.
We'll pick up on that conversation in just a second when we catch up with Thierry Wizman of Macquarie from New York City. You're watching Bloomberg TV. Let's do a couple of things. Let's start with stocks, then we'll get to bonds. Equities at the moment firmer on the S&P 500. This session highs up by 1.2%, supported by beats from Meta and Microsoft. Later on, Apple and Amazon. On the Nasdaq 100, we're higher by 1.8%. In the bond market, let's talk about this. I just want to sit on the front end of the curve. The 2-year at the moment is trading at 358. Yields are down by 2 basis points on the session. The Treasury Secretary, Scott Bessent, speaking to Fox News earlier on this morning, saying the 2-year rate is below Fed funds, and that signals this Fed should cut. Fed funds is about 450.
So I'm old enough to remember when he said that he wasn't going to talk about or comment on the Fed policy because ultimately this was the Fed's job. And at their lunches every week, he lets them do their thing. At the same time, it is increasingly evident that there is focus on how to conduct monetary policy based on the president's comments, as well as who's going to take the blame for an economy that a lot of people say will clearly weaken heading into the next few months.
We've asked a lot of questions about Fed independence in the last couple of weeks, that's for sure. Under surveillance this morning, the greenback safe haven status in question.
We try not to be too alarmist about it. We don't think the dollar is going to lose its reserve currency status overnight. I think there could be a risk over the long run if the goal here by the Trump administration is to reduce those trade deficits. Then maybe that means we have less of a capital account surplus, and it means foreigners over time don't need to hold as many dollars. Obviously, there's concerns out there, but we're not saying you need to get out of the dollar.
So here's the latest this morning. The US dollar posting its worst month since 2022 as tariff turmoil weighs on the US currency. Thierry Wizman of Macquarie writing, to avoid poor GDP growth, the US administration will have to shift aggressively towards more negotiations and concessions on tariffs, a renewal on tax cuts and tax reform, and more deregulation. Thierry joins us now for more. Thierry, good morning.
Good morning, John.
Thanks for being here. Let's sum up and wrap up the month of April. What did you make of that?
Well,
Take breath, Thierry.
Well, look, going into April 2nd, I don't think that anyone thought that the tariff announcements were going to be as aggressive as they were. So if you have to point to a surprise in April, it's the aggressiveness, the pugnacity of the tariff policy that came out on so-called Liberation Day. And that was a shock, and that caused two things to happen. First of all, it created the sense that we are going to have not just a prospective U.S. slowdown, but potentially a global slowdown sometime starting in the second quarter. But I think the more structural thing that happened, the more profound thing that happened, was that all of a sudden there was a sudden shock to people's perceptions of the United States. The United States as a counterparty, as a full faith and credit counterparty. The United States as a protector and guarantor of international law and international customs. Of course, international law and customs that the U.S. itself helped build post-World War II. I think those things created a loss of confidence in the U.S. The arbitrary nature of the tariffs, the abruptness of the tariffs, the aggressiveness of the tariffs on Liberation Day created that change in perception and sentiment. Even if the U.S. were to walk back all of the tariffs that this administration put on, I don't think we're going to get back to a situation where people are going to fully trust the U.S. again. And I think that is going to have an implication for the markets, but especially for the currency. I don't think, for example, that the days of American exceptionalism that we witnessed in the fourth quarter of last year and the early part of this year, really a story about American exceptionalism began in 2012 because we had a stronger dollar since then, effectively. I don't think that's going to return anytime soon. Does that mean that the dollar can't appreciate a little bit from here? I think it can. There is a lot of things pointing to the prospect that it is already oversold on a technical basis. You can see that in positioning. You can see that in risk reversal pricing. But the idea that we were going to get back to where we were in early January, I think that ship has sailed, and it has sailed for good.
Equities recovered in April. Bonds recovered. The dollar did not. You say this ship has sailed for good. Where's the ship going to?
Well, again, if we see... It depends, again, on how much of a walk back we're going to see.
What are we rebalancing towards? The euro? The Chinese currency?
Oh, yes. It's going to be, prospectively, anything that can serve as an alternative reserve currency, any currency of any country that is deemed to be a safer harbor than the U.S. in view of the arbitrariness and the uncertainty emitting from U.S. policy agenda. I don't think it's going to be the yuan. We have to wait until, the China opens up its capital markets a little bit more. But certainly the euro, certainly the yen, sterling to some extent, the Aussie, the Canadian dollar. These form a complex of currencies in countries and regions, in the case of the EU, that are perceived to be more stable at this point.
How much does that increase structurally the funding cost for the United States if people are not looking for places to park their cash and dollar-denominated assets?
Yeah, so you're not going to see it now. And the reason you're not going to see it now is that the perceptions of a recession and the prospect of a recession in the U.S., at least in the mindset of traders and investors, is too strong to allow yields in the U.S. in the Treasury market to go up. In fact, every recession, with the exception of one since the end of World War II, has been associated with a decline in U.S. rates, base rates, Treasury rates. However, when this fear of recession passes, we are probably going to settle into a real rate environment for the U.S. that is higher, a real yield environment in the U.S. that is higher than it otherwise would have been if we never had this episode to begin with.
Let's talk about policy response. Treasury Secretary Scott Bessent just said moments ago that the two-year rate below the Fed funds rate signals that the Fed should cut. Do you agree?
They have a point, and the point is this. Even before the election in the U.S., we were already seeing some weakness in the U.S. economy among low-income consumers, in the cyclical sectors. It looked like things were heading down, and they were heading down because of the pressure of high interest rates, presumably. The thing that saved the U.S. economy in Q4 was that we had an election that created some exuberance among high-income consumers, and of course we had government spending taking place in the last few months and weeks of the Biden administration. They were trying to get all of those fiscal allocations out the door. So that saved the U.S. economy. But underlying that bump was a slowdown. And I think if there's a case to be made for lower rates, it's that case, that we already have fragility among the consumer and some businesses. However, and there's always a however is we have no idea what the impact of the tariffs are going to be on inflation and inflation expectations. In the case of the U.S., it's almost assured that measured inflation is going to go up if the tariffs stick. That's very different than what's happening abroad. The implication of U.S. import tariffs for Europe, for Japan, for the UK, for Canada even, for Australia, for the emerging markets is disinflation. Those emerging market central banks and developed market central banks that are confronting that disinflation have the luxury of being able to speak more dovishly and act more dovishly. You're seeing it with the Bank of Japan overnight. But the Fed, it doesn't have that luxury right now.
The president once again yesterday suggested he knows more than Fed Chair Jay Powell. Then you hear from the Treasury Secretary today, which a few weeks ago said to me, monetary policy is a jewel box that needs to be preserved, even if they have a case to make. Is it appropriate that they're making it?
Like I said before, I think they have a point. It may not be a point that is strong enough to overturn the current consensus of the FOMC. It may not be a point that is valid enough to overturn the current consensus of the FOMC, which is to wait. But it is a point, and it is a valid point. There is a cyclical downturn in the U.S. that was prevailing before the election, and the only reason we didn't see it show up in GDP growth in Q4 is because the election created a burst of exuberance and because we had a lot of government spending. I think the administration is concerned that going forward, there's going to be less government spending, there's going to be retrenchment on the budget, and now they're seeing, of course, the impact of tariffs, although they won't tell you this, on sentiment among high-income spenders, and those high-income spenders, those luxury spenders, those discretionary spenders are retrenching as well. You see it, of course, with the guidance we're getting from some U.S. corporations recently.
Terry, we've got to go. Appreciate your time as
My
always.
pleasure.
Terry Wizman there from Macquarie. Neil Dutta of Renmac agrees. The Treasury Secretary, he says, knows how to feel the market. Up next, we'll catch up with Sonders of Charles Schwab, Dan Ives of Wedbush, Nela Richardson of ADP, Ian Lyngen of BMO.
The S&P today is a very different animal than it's been historically.
U.S. assets are still a safe haven.
I see a lot of duration risk in the market.
A couple of hard data points are already enough to really drive us a leg lower in risk assets.
This is a global rebalancing from a very overweight position in U.S. assets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, 90 minutes out from the opening bell, and your scores look like this in the equity market. Equity futures looking to extend the winning streak from day 7 to day 8 on the S&P 500 right now, firmer across the board. We're up by more than 1%. On the NASDAQ 100, up by 1.8%. Thank you, Meta. Thank you, Microsoft, in the pre-market, doing nicely. Both of those companies delivering a beat after the close yesterday. Microsoft up by more than 9 percentage points in the pre-market. Let's turn to the bond market and sit at the front end of the curve on a 2-year this morning. Your yield, 3.58. Yields lower by 2 or 3 basis points. And this message coming from the Treasury Secretary, Scott Bessent, just moments ago to Fox News early this morning, saying this: the 2-year rate below the Fed funds rate signals this Fed should cut.
And clearly, a number of people agree with him. Neil Dutta, as you mentioned just moments ago, coming out and saying that the Treasury Secretary knows how to feel out the market. Wage and salary growth is running below the level of the Fed funds rate, a sign that past policy has already been too tight. That said, there is a larger question, especially after Treasury Secretary Bessent's comments about not commenting on current Fed policy, about how much this current administration is leaning on this as a real question mark. Has this Fed chair acted in an appropriate way, given some kind of slowing in the economy already heading into this period?
This is another layer of jawboning at Jay Powell. We heard it from the president in Michigan when he said that person running the Fed doesn't really know what he's doing. And then yesterday as well from the White House, he talked about the fact that Jay Powell is, quote, not really doing a good job. And to Lisa's point, the Treasury Secretary told me weeks ago, monetary policy is a jewel box that should be independent. Now there's going to be these questions yet once again about whether or not there's an independent Fed under Trump 2.0.
I think a good question in the news conference next week, next Wednesday, take the Treasury Secretary's name out of it. Just ask him about that measure. Just say at the moment the 2-year yield is trading below Fed funds. Is that a sign that you're too tight right now? And see what he says back to it.
Well, I think that that's a great idea. Anyone taking notes, please ask that question.
Mike McKee, if you're watching.
Because, Mike could ask that question. Because ultimately, there are a number of people, and Terry Wizman just said basically yes. There is a sense that the economy was slowing heading into this. The big question mark, and this is really kind of the issue for a lot of people, we don't know what the tariffs are actually going to do to inflation expectations. We haven't seen that pricing pass along yet. That's why it's a fly in the ointment that they cannot dismiss.
Companies are juggling this as well. We've heard from several already this morning. So GM is cutting guidance. Harley-Davidson is pulling guidance. The earnings that came from McDonald's were softer. In about 27 minutes' time, you'll get more economic data. Jobless claims at 8:30. One to watch. Then later on this morning, Lisa, ISM Manufacturing at 10 a.m. Eastern Time.
Which will be important given the fact that supposedly companies are moving back manufacturing here, and yet we've seen a bit of a weak spot there. Some of this data, the ISM Manufacturing, we saw that Dallas survey where you just saw manufacturers report real severe declines in confidence. how much and how quickly can we see the soft data converge with the hard data will continue to be a question.
Improving confidence over the past few days, the past week for that matter. Your equity market higher by 1.2% on the S&P. Coming up this hour, Sonders at Charles Schwab with stocks riding a 7-day winning streak and looking to make it day 8. Dan Ives of Wedbush on big gains from big tech, and Nela Richardson of ADP looking ahead to the payrolls report. We begin this hour with stocks higher following strong earnings from big tech. Sonders at Charles Schwab writing, earnings season is better than expected so far, but guidance looking ahead continues to be murky at best. We still think an up in quality factor focus makes sense. Lizanne joins us now for more. Lizanne, good morning and welcome to New York City.
Good morning. Nice to be here.
Good to see you in person as always.
Ditto.
Let's talk about what we've heard so far from corporate America. Can you get a clean read on things at all?
You know, I've been listening to you guys this morning and talking about the rules of the game. I think what you're also hearing from business leaders is not just we're unsure about the rules of the game, but what is the playing field? Are we on a soccer pitch? Are we on a basketball court? So I think it's the combination of those things. And it reminds me of the early part of COVID, when you had, at that time, a record number of companies just withdrew guidance altogether. And that's that, you know, businesses have put themselves in a timeout, similar to what the Fed has done, which has put itself in a timeout. And that's probably the right position to be in.
I feel like I'm ice skating really badly and face planting every couple of days. Isn't that what it feels like?
Yeah, on a soccer pitch. You're ice skating on a soccer pitch.
Just to describe the last month, the fact that we ended up finishing the month down by 0.75%. Have you ever seen a month like that where you're down 0.75%, but it feels like you're down 20?
Maybe October of '87.
Is that the parallel for you?
Well, the year of 1987 was almost completely flat. Yet, obviously, what happened along the way was extraordinary, particularly around that crash period of time. I think more recent examples, I think COVID is probably somewhat of a proxy for this. Maybe the important difference being, you know, we had this massive uncertainty, sort of freeze activity. But at that time, we kind of knew not only what the solution would be, health-related solution, vaccines, but also massive, massive stimulus, both of the fiscal and monetary variety. Now, when you don't really know the rules of the game, trying to gauge, okay, what ends this? What do deals look like? Not to mention, there is monetary firepower, but it doesn't really get to the heart of what is plaguing the economy right now. This has not been a problem of interest rates being too high or credit constraints or a serious plumbing system problem in the financial system. And arguably, there's less fiscal firepower. So that's, I think, the important difference between today and the COVID period.
We also don't know who the potential winners are going to be on the other side. Is it going to be the big tech players that really were the beneficiaries or some of the biggest ones on the heels of the pandemic and what happened with respect to everyone staying at home and buying 15 iPads? Or is it going to be some of the industries that are going to be reinvesting in domestic production? What's your sense?
I think another thing that was interesting about April with the renewed interest in tech, and even beyond that, the so-called growth trio, as I like to call it, tech communication services and consumer discretionary that house the Magnificent Seven. I think what we're seeing in the month of April is sort of the resurgence again of actually retail traders into their favorite hotspots. You know, Goldman Sachs has some of those great indexes, and their meme stock basket has been on a tear. You see the Vandatrack research that tracks what retail traders are doing. So institutions have pared back and CTAs have pared back, but that's where I think you're seeing that buy the dip mentality. And that sort of has this knee-jerk back into tech and AI-related names. Whether that's sustainable is hard to judge.
Well, that's what I was going to say. You sound deeply skeptical. If the institutions aren't following suit, then there could be an argument made that the retail traders are just basically doing a knee-jerk response based on what has worked in the recent past. On the flip side, they've been right sometimes.
They have been right sometimes. And there have been periods in the last decade or so where you've seen retail investor optimism stay high. You see it sink on the institutional side. And the convergence has been a catch up by the institutional side, not a catch down by the retail side. I don't know how, it might be actually a little bit of both this time, but that's where they continue to sort of place their bets. And I think a day like today, when you have Meta and Microsoft as two of the poster children for this. When you've got more direct in the teeth of the tariff stuff, like Harley-Davidson or General Motors pulling or lowering guidance, there's also that dichotomy that I think is an interesting one that has manifestations in market behavior.
Lizanne, when we're trying to understand what's going on, you talk about COVID as being this proxy. Why is Trump 1.0 not a proxy for Trump 2.0?
I think the nature of the people who are advising Trump, I think there might have been a little bit more pushback by many members of the cabinet. For whatever reason, the equity market seemed to be the driver of the Trump put at the time. Now a little bit more on the bond market side. So in terms of whether we get to that moment again, I think the bond market is more in the driver's seat now than the equity market. Plus, frankly, the 2018 trade war tariffs, they were minuscule compared to what we're dealing with.
And it was focused
now.
really just on China.
And importantly, when you hear people talk about the offset of major tax cuts coming, it's the extension of the 2017 tax cuts, on the margin potentially more. That's a very different backdrop than what preceded 2018, which was brand new tax cuts. So the difference is we got the candy first and the spinach later. Now the spinach first this time, and it's aged a bit more, the spinach, by virtue of just the scope and size and the global uncertainty associated with
If
this.
the bond market is the Trump put of 2.0, what's the level?
I don't know if it's a level per se. I think it was the speed with which we saw the move from 3.9 to 4.5 on the 10-year. So direction of travel, but speed of travel, I think, is maybe more important than a particular level.
8:30 yesterday, Lisa picked up on it almost immediately. There was a stagflationary mix to the economic data. Did you start to feel like investors were reaching for a stagflationary playbook? And what does that look like?
I think that is the flavor that we're getting out of recent economic data points, certainly embedded in the GDP and related data that we got. What I find interesting, though, is, you can track mentions on conference calls, and we're right in the teeth of earnings season right now, and stagflation mentions have actually come down. But tariff mentions continue to spike. So maybe now companies are just getting right to the heart of this is how it's going to impact us, as opposed to just speaking in more macro terms. I think what we're also facing right now, and part of the reason why bond yields have come back down, is there was a lot of debate as to what would happen first. Would you get the growth weakness first, or would you get the pop in inflation? It looks like we might be getting the growth weakness first. Last thing I'd say is this notion, probably accurate to some degree, that this would be a one-time step up in prices. First of all, I think there are still ripple effects. We talk all the time about if you've got a significant increase in the average price of a car, well, that also raises insurance rates. So there are tentacles here. But I think it's also important, even if it is just a one-time step up in prices, you guys know this. This is how consumers think of inflation. We're all in the weeds of core versus headline, month over month versus year over year, core services ex housing. Is it PCE, CPI, PPI? The person on the street says stuff is more expensive than it was, a year ago, pre-COVID, whatever the reference point is. So that matters because of animal spirits and the psychology of not just inflation, but the economy more broadly.
They have a tendency to extrapolate it out and behave accordingly. Then that's the worry of this Federal Reserve. You can see it's why the chairman at the moment has repeatedly, Lisa, again and again and again, pledged to anchor inflation expectations. Repeatedly done that going into this meeting.
And it's especially salient because we're coming from a higher inflationary place where companies have been able to pass along price increases. And it's something Mohamed El-Arian has talked about. The fact that there aren't sort of suggested prices on different goods is actually really important because a lot of companies are saying we can adjust things around the margins and just test the waters and see how much we can actually pass along to
They want
consumers.
maximum flexibility, but what did you make from the news from Ford? That Ford was basically waiting to see what everyone else was going to do.
I thought that was fascinating. Basically, that they would have to increase the prices maybe $5,000 or $10,000 per vehicle, but they wanted to wait to see if their competitors were doing the same because they don't want to lose market share. So there is this ultimate test, and we heard this earlier this morning, where companies don't know and they're going to wait, maybe order some things, try to pass it along. This is a huge experiment where we don't know where we're coming from and we don't know where we're going.
Lizanne, just to finish there, starting points matter. Consumer price tolerance now versus a couple of years ago coming out of the pandemic? How different are things now? The ability for companies to say, you know what, prices are going up 10, 20%.
There may be more of an less emotional tolerance for higher prices, in part because of the policy decision aspect of it, as opposed to COVID. I think that's a very different backdrop. Lisa, I also think it's fascinating what you talked about, because part of the reason for weaker GDP that we got yesterday was the massive surge in imports. That could continue a little bit, which means then you have to think about the flip side of that when that ends. But it also means that companies have really boosted their inventories. That might push out the empty shelves concern about this. It also maybe gives companies a little wiggle room, to your point, to try to test the waters with price increases, because they've got a lower cost basis now in this inventory build. Let's see what sticks and what doesn't. So you could see a lot of volatility as they try to figure out what sticks.
It's going to be a volatile summer for the economy, that's for sure. Lizanne, fantastic to catch up in person. Thanks for being here.
My pleasure.
Appreciate it. Lizanne Sonders there of Charles Schwab. Your equity market near session highs up 1.2% on the S&P, with an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. GM lowered its full-year profit outlook, saying it expects a tariff impact of up to $5 billion this year. It's among the biggest financial hits revealed by any company so far from President Trump's trade war. GM's lowered guidance comes even after Trump issued some relief for automakers by lowering some levies on imported vehicles and parts. Meanwhile, Airbus says it won't cover the cost of tariffs on its planes imported by U.S. airlines, setting up a clash with the carriers. The plane maker's CEO says its customers are not willing to pay the levies, but that's on them. Airlines, including Delta, say they won't pay the extra cost, but are finding workarounds, such as routing new aircraft through another country first. And a federal judge ruled that Apple violated a court order by not opening the App Store to third-party payment options. The judge referred the case to federal prosecutors to investigate whether Apple committed criminal contempt of court for ignoring her 2021 ruling. Apple must now make changes that could put a sizable dent in its App Store revenue. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the programme, the morning calls plus Dan Ives of Wedbush with tech earnings in full swing. The opening about 1 hour and 12 minutes away. Going into it, equity futures near session highs up by 1.2% on the S&P, up by 1.9% on the Nasdaq. That's the price action. Here are your morning calls. First up, HSBC downgrading UPS to hold, saying tariff headwinds are weighing on the outlook. That name is down by 0.1%. Your second call from Bank of America, raising its price target on Microsoft to $5.15, highlighting its strong earnings report driven by cloud growth. That name is up by 9% this morning. And finally, Morgan Stanley raising its price target on Meta to $6.50, saying it remains the, quote, cleanest GPU-enabled leader in the space. That name is up by close to 7% in early trading. Let's stick with tech. Apple reporting results after the closing bout today. Dan Ives of Wedbush writing, we remain bullish on the long-term opportunity for Apple's flagship ecosystem. Investors need to look past the next 3 months and assume China tariff negotiations take a positive turn. Dan, optimistic as always, joins us now for more. Dan, welcome to the programme, sir. Let's get straight to it with Apple. How are you going to draw a distinction later on this afternoon between a front-loading, people rushing to the stores before the tariffs, and decent, sustainable underlying demand?
Yeah, I'm actually less focused in the quarter, as you talk about in terms of pull forward or front loading. It's really about what Cook talks about in terms of tariffs. Like, are they going to stay on schedule with the iPhone 17 launch? You know, how are they going to sort of scenario analysis in terms of everything they're seeing in China? They're waiting to hear from Trump administration. Those are the keys. I actually think numbers take a back seat to Cook's commentary about that.
So, Dan, let's talk about the guidance then. What kind of scenarios they could offer and what you think of the approach so far from corporate America, because we've seen a range of things done. Some people have just pulled guidance, haven't offered any. Other people have cut. Some people have offered multiple scenarios. What would you appreciate? What would you prefer to see this afternoon?
I'd prefer no guidance. because I think if you give guidance, you actually put your back against the wall. They could give some sort of scenarios, but it comes down to June's a mulligan. It's a toss-away quarter. I think the really focus is, do you launch in terms of September iPhone 17 and give some scenarios and ranges for investors to understand what this could do? Look, we've already factored 10% cuts in numbers. Worst case, 12 to 15%. Best case, 2 to 5%. That's how we're going into tonight.
John raised this really interesting point earlier, Dan, about how much forward buying there was over the past couple of months and frankly over the past couple of weeks to get ahead of any potential disruptions in shipments from China. Are you expecting to get any guidance about the pull forward effects and maybe that we could even see much better than expected numbers that will only be made up in maybe declines later on?
Yeah, look, there will be pull forward. And again, I think numbers are actually going to be very strong. And I think they could quantify some of that, but that's sort of breadcrumbs. I think the real focus is next few quarters, over the next 6-9 months, how they're going to navigate these tariffs, like in terms of maybe even talking about some supply chain plans, the India, scenario. I think any commentary like that would be very important to understand from Cook, to kind of put a flashlight in a dark tunnel when it comes to tariff scenarios.
We're hearing a lot of commentary about how maybe Meta and Microsoft have been somewhat immune. We're going to be hearing more potentially from Apple and Amazon. We got this reporting overnight from the Wall Street Journal that they were thinking among some of the height at Tesla, at some of the height of the carnage and some of the boycotts, that they were looking at potentially getting another CEO to replace Elon Musk. What do you make of that?
Look, we talked about it on your show, right? A lot. I mean, the point is, regardless the board denies it and the scenarios, this was the moment of truth. The board had to do something, whether it's a warning shot or whatever it may be. And Musk had to choose CEO of Tesla, dude. And we thought that conference call is probably the best conference call I've seen Musk do maybe ever, or at least in the last 4 or 5 years. So important because the brand damage and what was ultimately happening, clock struck midnight. So regardless of the semantics and what actually happened, what didn't happen, the end result is a huge positive. Musk back in the driver's seat, CEO of Tesla. And I continue to think like his days at the White House are essentially done.
Well, Dan, they're not, in the sense that he was at the cabinet meeting yesterday wearing not just one, but 2 Make America Great hats stacked on top of each other. Even though he is more focused maybe on Tesla now than he was in the beginning of this administration, when he was very focused on Doge, can that brand destruction still carry through?
Yeah, look, I mean, you've talked about that a lot. And I'd be surprised if these are other cabinet meetings. I mean, just given, I think, the pressure for him to sort of detach himself. But we've talked about brand damage. You got to contain it. You have a massive era of growth ahead, autonomous, robotics, turning things around in China, especially BYD in terms of rising, in terms of from a share perspective. Leaders lead. That's what Musk has to do now. And I just think like that was the move that he started to take on last week's call. And I think that's what we expect to see from Musk going forward. It's also why the stock's up. Because ultimately, now you have the biggest asset of Tesla back, regardless of the drama that went through between the board and Musk or whatever did or didn't happen.
Dan, let's finish on the biggest challenge to them right now, which I think could possibly be a tie-up between Waymo and Toyota. We're talking about the best-selling car brand on the planet, 2 of the best-selling models out of the top 3 in the world in the last 12 months, getting together with Waymo that's delivering 200,000, 250,000 paid trips every single week. Why isn't that a threat to Tesla?
Yeah, I personally think that's not as big of a threat as maybe some have talked about. Look, Waymo, $240,000 cars in 4 cities. They obviously will expand. They had the lead in terms of coming out of the gate. I think when it comes to cybercabs and Tesla, I think autonomous, the scale and scope, they're really going to own that market. So you're going to see more and more partnerships like this, but it's not like I view this partnership as something that changes my thesis on Tesla in terms of autonomous. But it also speaks more and more, Musk needs to be leading Tesla, not sitting there, as Annmarie said, wearing 2 or 3 hats in a cabinet meeting.
I'm guessing you're at the airport, Dan. Travel safely.
I am.
It's good to see you, sir.
Thank you.
Thanks for making time for us. Dan Ives of Wedbush there on Big Tech. In just a moment, we've got to talk about the data. Jobless claims just around the corner. Another read on the labour market ahead of payrolls tomorrow morning. Really important stuff. We're starting to see some cracks. Will you see it in the hard data? Nela Richardson of ADP joins us in just a moment, alongside BMO's Ian Lyngen from New York. This is Bloomberg. So we're on a really good run of gains on the S&P 500, 7 straight, extended the longest winning streak of the year so far, looking for day 8 and up nicely again this morning, lifted by what's happening elsewhere from big tech, from Meta, from Microsoft. Equity futures up this morning by 1 percentage point on the Nasdaq 100, up by 1.7. Coming up very shortly, a really important read on the labour market. This weekly data, just increasingly important following the policy volatility down in Washington, D.C. With your data this morning, let's cross over to Mike McKee. Good morning, Mike.
Good morning, guys. I'm still waiting for the data. I think maybe everybody is at this point, because the question is, what happens tomorrow when we get the jobs numbers? We, at this point, see a big jump in jobless claims last week, 241,000 up from 223 revised. So we do have some added jobless claims numbers here for the first time in many, many weeks, and really since the Doge people started their job cuts. The 4-week moving average is at 226 from 220, and the continuing claims number, 1,916, up from 1,833. The interesting thing, though, is we don't see a big rise in the number of federal employees filing jobless claims. Remember, they have a different category, only 470 people. We know that a lot more federal workers have lost their jobs, but maybe because they get severance, they're not quite eligible yet. Next thing we wait for is ISM at the top of the 10 o'clock hour on Wall Street, and we'll see what the jobs numbers say in that indicator as well.
So, Mike, I'll come back to you in a second. I just want to share the price action with you because we are responding to this. So it's an upside surprise on claims, the wrong kind of upside surprise, 241, the estimate 223. Equity futures come off the highs, now positive by just about 0.9%. And in the bond market, just another leg lower in bond yields. We're down about 3 or 4 basis points on a 10-year to 4.12. Lisa, just reading between the lines, weaker than was expected.
Yeah, and if you look at the continuing claims, that is actually particularly interesting, as Mike mentioned. It's actually the highest reading going back to late 2021. So you saw a real jump up. And there's a question here, how much is this people not able to find a job on the other side after having left the workforce? And that might raise a question about the stagnancy of a labor market that isn't very forgiving for people who might get kicked out of it in some capacity.
The range of estimates for tomorrow morning, incredibly wide. At the high end, we're at 171. That's the estimate for payrolls. At the low end, we're at 50. The median is 135. And Mike, the conversations we've had so far this week regarding payrolls have been very, very different. We've heard from Torsten Slock of Apollo, who's made the case that perhaps you could see a big downside surprise, maybe even a negative print. And other people, many in fact, Mike, have made the point that it's too early to expect the tariff volatility of the last month to hit hard data like payrolls. Mike, what are you hearing?
I think the latter view is correct. It is pretty early because the president announced his Liberation Day tariffs on April 2nd and then backtracked on April 8th, I think it was. And those are just at the very beginning of the cycle for the survey for the April jobs numbers. So they probably didn't have as much of an effect. But we will see it probably going into later months. And, of course, the jobless claims numbers we got today were for last week, way after the survey week. So this jump doesn't mean anything in terms of what we're going to get tomorrow. But if this continues, it presages maybe we get real slowdown when we get the May numbers in June.
Do you have a sense, Mike, of what people make of these initial jobless claims? It used to be one of the most high frequency and important tells, and then it went flat and people started to dismiss it as maybe not necessarily reflecting what truly was going on. How much are people using this to really model forward how we're going to see the labor market progress?
Well, I think what people are doing is looking at it as a sign that we have a fairly static labor market, that we're not losing a lot of jobs yet. Now, the thing that happens is when we start to see these jump up, other than the 1 week or two blips, they tend to go very quickly. And so if that starts to happen, then you'll see people get really worried about what we're going to see in payrolls.
Mike, appreciate the update, sir. Mike McKee there, breaking down the economic data. If you're just joining us, an upside surprise, the wrong kind on jobless claims, 241, the estimate 223. And as Lisa pointed out, continuing claims more elevated than expected as well. Joining us around the table, Nela Richardson of ADP. Nela, good morning.
Good morning.
Big downside surprise on your number yesterday.
Right.
What drove that?
Hiring hesitancy. There is a price of unease and a price of uncertainty. So I want to go back to what Mike was saying about the reference week, because I think this is very significant. The reference week includes the 12th of the month. And so we were at a time of peak uncertainty for small businesses, medium-sized and large businesses at this time period when this data was being collected, both in the ADP numbers and the BLS numbers. So what you might be seeing in the reflection of that 62,000 is a hesitancy. It doesn't mean it's a turning point, meaning that the labor market is being weakening. It could just be that people just let up their foot off the gas a bit when it came to hiring and went into wait-and-see mode. We've seen this before, and it was followed by a surge in hiring. So whether it's hesitancy or a turning point, it's the May data that will tell you.
I think it was Jamie Dimon at JP Morgan who last month said clients had gone into what? Wait-and-see mode. How many times have we heard that phrase?
And how that's going to translate into very noisy data that may give one signal, but maybe not the one that's the correct one. In other words, could we see negativity that doesn't really translate in terms of payrolls maybe in May or June or July?
Do you think that introduces some downside risk for this month, for the payrolls figure tomorrow?
Yes, I definitely do. This hiring hesitancy is prevalent. What I'm looking for is it going to be more frequent? Are we going to get more frequent pullbacks from employers who are like, let's wait and see, let's brace ourselves for what's coming? We don't know that. So far, even if there was a hesitancy, as I said, there was a rebound the previous month. So at ADP, we have a lot of data. We look not just at jobs, but hours, because before an employer cuts a job, they cut an hour. We actually saw that hours ticked up. Then we went into payrolls. We pay about 1 in 6 workers in the United States. We saw for people who switched jobs recently, pay growth went up. So the elements of the labor market are still solid. It really looks like employers are taking a pause, especially when there was a lot of uncertainty in that mid-April timeframe.
You say, as you look at all of this data, that you don't see a recession anywhere in here. This looks like really a strong labor market. How quickly could that change? I mean, is that something that is vulnerable, or is this really a very solid backdrop with a lot of uncertainty? Because why would anyone make big moves right now?
Right. So every year you're going into a year with a 1 in 4 chance of recession, about 25%. And so the question always is, what's the trigger? Well, we know what the trigger is in this point, how people are responding to what could be a transition in terms of higher prices from tariffs. The trigger is obvious to everyone. It's not always obvious going into a recession. We're also going into, we're still in an environment with higher than normal inflation and interest rates. So there is some trigger components that could lead to softness this year. But it's not yet coming from the labor market. It's not yet coming from a reduction in consumer resilience to the point that it's troubling. Even if you look at that contraction in the GDP numbers in the first 3 months of the year, you saw a moderated consumer, but not a down and out consumer. You saw that, domestic, the real economy grew by 3%, even as those imports swamped that growth. So Main Street's still okay. We don't know how long that lasts yet.
We're going to get ISM manufacturing data a little bit later this morning, and there's this question about whether some of the changes are going to cause employers to pull employment back to the United States, particularly in the industrialized sector. Are you seeing any signs of that, any increase in hiring?
Yeah, in fact, for the goods sector, it was pretty stable, but it wasn't as strong as it was the last 2 months in manufacturing. We saw this abnormal pickup in hiring in the first 2 months. I don't credit that with bringing employment back to the U.S. I think that's going to take a much longer time, because what that suggests is that you're not just bringing in people, you're bringing in infrastructure, you're bringing in facilities, you're having to invest. If you're a goods manufacturer, this is not a 3-month turnaround story. This is a yearly maybe even decade-long story. So we're not going to see that impact very, very quickly. This is really employers responding to the here and now of the policy rather than making big bets on the next 10 years.
Nela, I really appreciate this framing because I think it's so important. If we do get a weak number tomorrow, the way you describe it, it's employers basically reacting to an event to go into wait-and-see mode and not the start of a process for them where they start to lay people off, which could mean we start to go into recession. Now, you can do that for 1 month. Problem is, you start to do that for 2, 3, 4. It takes on a life of its own, and that's the risk here. That's why you're playing with fire with these kind of policies.
And it's also the reason why you're playing with fire when you extrapolate out a trend line based on one data point that might confirm a bias in the market, which is that things are going to be weakening. If you look under the hood, as Nela was saying, I think that is the most important, that hours actually went up and that pay increased for people who switched jobs. This is not the hallmarks of a market that is absolutely tanking.
If we get a weak number tomorrow, I'm pretty sure a lot of people will extrapolate that
100%.
out, like several years.
Yes.
End of cycle type stuff. Nela, thank you. It's good to see you.
Always
as always.
a pleasure. Thank
Nela Richardson of ADP will attempt to bring some balance to that conversation if we do get a downside surprise. Mike McKee joins us now for more. Mike, I want to talk about not just the labour market data, but the potential Fed response to it. You're going to catch up with the Fed Chair, Jay Powell, next week when you head down to Washington, D.C. for the news conference. Now, nobody's expecting a change to policy, but Mike, I'd love a question from you to him if possible. The Treasury Secretary, Scott Bessent, said this morning that the fact that the 2-year yield was trading below Fed funds was evidence that the Fed was too tight. Mike, how do you think the Fed would respond to that as a question?
I think at this point, the Fed would probably look beyond it and say, we don't know that. I mean, we want it tight right now because we're still trying to bring down inflation to its target, but the tariffs could be inflationary. And the last thing the Fed would want to do is cut rates and then have to raise them again if inflation started to go up again. So they would dismiss something like that. I do want to point out, John, that tomorrow, the idea of a weak number is kind of off the mark for the Fed because the Fed's going to look at the unemployment rate rather than the number of jobs created. 138,000 would be okay for the Fed because they think you need about 100,000 as a replacement rate. So they wouldn't worry about it, but it may get the market's attention. They're going to keep an eye on the unemployment rate because that suggests then that companies are taking active efforts to manage a downturn.
Unemployment at the moment, 4.2%. The estimate for tomorrow morning, 4.2%. Mike, thank you, sir. Mike McKee joining us on the data and a look ahead to the Federal Reserve next week. To extend that conversation, with us around the table now, Ian Lyngen of BMO Capital Markets. Ian, good morning.
Morning. Thanks for having me on.
I'm going to repeat that question for you. The Treasury Secretary, Scott Bessent, said because the 2-year yield is trading below Fed funds, it's evidence that they are too tight and they should cut interest rates. What's your response to that?
It's suggesting that the market anticipates that over the course of the next 24 months, effective Fed funds is going to be lower than it is. That doesn't mean that now is the time to cut. That just means that the market is telling us that the Fed will resume normalization at one point.
Does it concern you that there is so much discussion around Fed policy from administration officials?
Well, we came into this knowing that there was going to be some political pressure put on Powell. There's been conversations coming out of the White House about potentially removing him. I don't think that that's really in the cards, nor do I think that's frankly possible. It's not surprising, however, that we have started to see some negotiations with potential replacements for Powell coming into, whether it's via the media, whether it's conversations that have been had at the White House. So I'm not really surprised, but somewhat apprehensive of the uncertainty created by this political pressure.
Well, that's what I was going to say. On the margins, does this affect not just Fed policy, but also how the market responds to it if there is this feeling that there will be somebody else coming in, that there could be a shadow Fed, that there is pressure increasing job owning, and frankly, that Fed officials may feel like any decision or words that they say will be interpreted in a political way, both in the market and in the White House?
I don't think it's really atypical for the administration to be pushing back against any given Fed or any head of the Fed. But what I think what's so unique in this cycle is how vocal and how real time it has become. Typically, you would expect any sitting president to want the easiest monetary policy possible, but Powell's objectives are for the long-term stability and health of the U.S. economy, which involves price stability, and that's the battle he's fighting at the moment.
Ian, because it's so vocal, and the Fed chair had to come out and say this is inappropriate in a sense, saying by law he's allowed to stay in his job. Does it make it harder for them to cut rates if they had to? Because then it just looks like they're placating the President of the United States.
Well, I think something that we've learned over the course of the last several weeks is, yes, there's a Powell put, but there's also a Trump put. And the Trump put is struck higher than the Powell put. Powell doesn't want to encourage and reinforce behavior in the White House that isn't necessarily going to be good for the long-term health of the economy. And so, to your point, I think that when Powell deems it time to resume normalization, that's when it happens, and he won't give in to the political pressure.
Following the Treasury Secretary's comments about the 2-year rate below the Fed funds rate, Neil Dutta put out a note and said wage and salary growth is running below the level of Fed funds rate as well, meaning it's already too tight. What do you make of that argument?
Well, I will argue that the bulk of what has occurred over the last 6 or 8 weeks has been really a uncertainty-inducing event, and it follows intuitively that as some of the backward-looking data could suggest that it's time to cut rates, that the market is focused on those aspects of it. There's also aspects of the data that suggest that the Fed should continue to remain on hold until September or later, which is actually my assumption at this point.
It's a really difficult moment. Take the numbers from Visa. We mentioned this just yesterday. We've not seen any signs of overall consumer spending weakening. That's from the CEO. From McDonald's right now. This is what they're saying. They're cautious about the overall health of the consumer. They're seeing pressure hitting the middle-income consumer in America and elsewhere. Pick your poison right now. It's difficult.
And that's the reason why cruise liners are up. But if you look at one cruise liner, it's up, but maybe not the other. And then you have people saying, well, sometimes companies are just trying to use the circumstances as an excuse to talk about weakness that might have already been present in their business models. It is difficult to understand whether this consumer is going to be tolerant of price increases or not, which is the reason why you might see some testing by companies to see, let's get a sense, can they absorb this and can we pass it along?
I don't think it gets any easier from here. You're going to see way more distortions in the data for weeks, maybe even months to come. Ian, it's wonderful to catch up with you, sir. Appreciate it. Ian Lyngen there of BMO Capital Markets. Equity futures at the moment on the S&P 500 higher by about 1 full percentage point, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. Recapping that latest data, an upside surprise to jobless claims hitting their highest level last week since February. Initial claims coming in at 241,000. The median in a Bloomberg survey of economists was calling for 223,000 applications. Continuing claims also coming in elevated, rising to 1.9 million. And McDonald's shares are falling nearly 1.5% after reporting a sales decline in the first quarter. Sales dropped 1% globally compared to a year ago, driven by a big decline in sales in the U.S. The results suggest that McDonald's focus on value meals has not been enough to get anxious consumers to spend. And General Motors shares are rising 3.7% despite lowering its full-year profit outlook. The automaker cited exposure to as much as $5 billion in tariffs. GM's lowered guidance comes even after Trump issued what he's characterized as relief for automakers by lowering some levies on imported vehicles and parts. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Bloomberg's Ed Ludlow, looking ahead to numbers from Apple and Amazon. From New York, you're watching Bloomberg TV. Equity futures on the S&P still elevated here by 1 full percentage point on the S&P 500. Lots of earnings to talk about. Let's get you some movers. We can do that with Danny Berger. Hey, Danny.
Hey, John. And I got to say, this is a market that's very willing to reward earnings when they show up and they beat. The tech giants so far have shown us this. Microsoft, one of the biggest gainers pre-market on the S&P, up more than 8.5% this morning. Their cloud business, really strong results, just shows the AI demand. And the company underscoring the fact that they still are going to be investing in AI despite some of those reports of canceled U.S. data center leases. Same goes for Meta. Post-market yesterday, also strong results too. That's sending their shares higher by 6.8% this morning. Mark Zuckerberg saying that we are ready to weather economic uncertainty, macroeconomic uncertainty. Results beat, forecast beats, and at the same time, the company being rewarded for that, up 6.8%. Finally, GM, even though the numbers weren't good, the shares are higher. We finally got some contours of what a tariff hit might look like to them. It is a profit lowered by $5 billion for the entirety of the year. But Mary Barra is saying that they're continuing a dialogue with the Trump administration. Perhaps that's why shares are higher, saying that they will remain nimble. Those shares up 3.7%, John.
Danny, thank you. A couple of names to watch going into the opening bell. That opening bell is about 38 minutes away. As we count you down, your calendar, your trading diary looks a little something like this. At 9:45 Eastern Time, we'll get some PMI data. ISM manufacturing at 10 a.m. Look out for that. Then after the closing bell, two big names, Amazon, Apple. Tomorrow morning, the payrolls report, and next week, of course, a highlight of next week, looking ahead to Wednesday, Fed rate decision and Chairman Powell news conference. With us here in New York, I'm very happy to say Ed Ludlow joined us with a preview of two big names after the closing bell. Let's start with Apple.
Yeah.
What's front and centre for you?
Yeah, this is a company that makes consumer electronics, and all of those parts are moved from one jurisdiction to another around the world. And so if you want to learn something about not just the impact of tariff is a levy, a cost. But as we've been reporting in detail, there's also an issue of moving a good across a border and a customs review and all the stuff about, flying tons of iPhones out of India into the United States. I think you're going to get a really real answer on what's going to happen going forward. Forget the numbers in the quarter gone, I think is what my mate Mark Gurman would say, and look forward.
How easy is it to move production out of China to India to satisfy the demand here in the US?
It's not easy. Basically, there's a limit on the number of handsets that India can produce currently. Of the millions it sells around the world, it's I think 20-25%, right? So it's also more about when you have an assembly facility. We talk about Apple being highly vertically integrated, but it relies on a contract manufacturer, Foxconn. That contract manufacturer in small cities in China has all of the critical parts suppliers with buildings literally around it. That infrastructure doesn't exist in India currently at that scale. So it's not just saying, I've got to put my assembly plant in India. It's about saying, and then I've got to get the screen and RF components also nearby. And that takes time and money.
There's a larger question also about just their AI development and whether they've been able to get on that train quickly enough to be competitive, right, so that they get some sort of competitive edge and market share. What are we expecting to hear today from that?
I was looking around the table. We all have iPhones, right? I don't use Siri. I haven't used it since it...
Never used it once?
Yep.
Not once. Don't even tell.
I use ChatGPT, I use Meta AI, I use Grok, and I use Gemini to extent on a daily basis. And the Siri functionality, I think the reporting's there that it was sort of rushed and it doesn't offer anything useful. Now, we did have a piece of news that you may have missed amongst everything in the last 24 hours, that Sundar Pichai of Alphabet talking up the prospect of Gemini and its integration into Apple. What we know from Mark Gurman's reporting in particular is that the heads have rolled, right? Executives have changed, the structure of the org has changed. But really, it still is a story about handsets. How many handsets do you sell? And whether the attractiveness of the software helps that or not, I think that's what they will focus on.
Ed, it's good to see you. Great to catch up. Look out for Ed Ludlow, Caroline Hyde at 11 a.m. Eastern Time for Bloomberg Technology. Look out tomorrow, 8:30 Eastern Time. Payroll's just around the corner.
At a time when we have the lowest two-year yield going back to September of last year, as people take a look at what we just saw with initial jobless claims, the unkind kind of upside surprise. What does this mean for what's coming?
I'm interested to see what the Truth Social is going to be. Jonathan, you talk about the drafts. I'm sure there's a draft saying that it's Biden's data if it's bad, and there's a draft being worked up if it's really good data. That's all the tariffs and manufacturing and those jobs coming onshore.
Looking forward to the reaction from the strategist, President Donald Trump, a little bit later this week. Coming up tomorrow, Priya Misra of JP Morgan, Sarah House of Wells Fargo. We'll catch up with Jeff Rosenberg of BlackRock, Mohammed Al-Aaron of Queen's College, Cambridge. From New York, thank you for choosing Bloomberg TV.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. Defending champion Iga Swiatek avenged her defeat to Madison Keys in the semis at the Australian Open with a 3-set comeback win to reach the Final Four. After losing the opening set 6-love in just 24 minutes, Świątek found her feet on the dirt, dropping just 5 games in the last 2 sets before closing out the win 6-2 in the decider.